Hello, good morning, good afternoon, good evening. Welcome to the BIS Research Conference on Regulating Big Tech between financial regulation, antitrust, and data privacy. It is a pleasure to have you all here to discuss important issues for our economies and financial systems. We have an outstanding group of central bankers, public officials, academics, civil society, and private sector participants. We would have liked to invite you to join us in person here in Basel, but we could only do the next best thing and meet virtually. One of the most striking features of the digital economy is the rise of large digital platform companies, big techs. More and more, big techs are a part of our lives and daily lives, I would say. Just look at the billions of people who were affected earlier this week when some of these platforms were down. Many of us here have used a big tech service today, perhaps by checking our email or sending a message on social media. At other times, we might order a product on an e-commerce platform. Big techs are entering financial services. At the BIS, we have been closely following how big techs offer payments, insurance, wealth management, and more in every major region of the world. These trends are even more remarkable since big techs were almost non-existent in financial services only a decade ago. But thanks to network effects, where users attract more users, big techs have achieved scale very rapidly. For example, big techs have come to account for 94% of mobile payments in China in the space of just a few years. Big tech credit grew by 40% in 2020 alone to a global total of over 700 billion. Beyond credit, big tech stablecoin proposals like Facebook's Diem may soon go live, likely with rapid adoption around the world. Big tech services in general, but also in finance, have certainly brought many benefits, yet big techs in finance raise at least three new challenges. For central banks and financial regulators, the first and most direct set of challenges centers on financial stability. Big techs have advantages stemming from their user data, leading to vast networks and a huge range of activities. These advantages give rise to the so-called data network activities, or DNA, feedback loop. With this, big techs can move very quickly from too small to care, to too big to ignore, to too big to fail. Just four big techs provide nearly 2/3 of global cloud services, which are becoming a critical service for the financial sector. Cloud services bring advantages in terms of efficiency for individual institutions, but the dependence of the entire financial sector on just a few players makes the system more vulnerable to large-scale operational failures, insolvency, or cyber attacks. A second challenge from big tech is preserving fair competition. This is especially important for competition or antitrust authorities. Big techs have several competitive advantages over other firms thanks to their business models, technology, and networks. In many cases, this is compounded by inadequate regulation and the possibilities of regulatory arbitrage. This can be harmful for competition since digital markets are subject to tipping in the favor of one player who takes most of the market. Mergers and acquisitions can make this problem worse. There is evidence that some acquisitions by big techs neutralize competitors, so-called killer acquisitions. This may end up reducing funding for innovative market entrants, a situation known as the kill zone. A third set of challenges is around data governance. This is particularly relevant for data protection authorities. Big techs have an incentive to collect as much personal data on their users as possible. This is because data resources are key to their business. When big data are parsed with advanced techniques like artificial intelligence, they can predict user actions in ways that users may not grasp. Big tech may even exploit behavioral biases to manipulate consumers' preferences. Research, which will be presented at this conference tomorrow, argues that this can lead to a range of harms, from undermining consumer privacy and choice to damaging political discourse. Beyond the economic consequences, ensuring privacy against unjustified intrusion by both commercial and government actors has the attributes of a basic right. Looking further ahead, one question is what the future financial system could look like with big techs. Thinking about this involves some leap of the imagination. But recent experiences with big tech suggest that without a public policy response, two scenarios, which are not necessarily the only ones or mutually exclusive, could be more likely than others. In the first scenario, big techs could establish a large footprint in retail payments by providing their own means of payment. In the current system, big tech provide front-end payment services for fees, but back-end clearing and settlement use public infrastructure anchored on the central bank's balance sheet. However, big tech's large networks and data could allow them to develop their own payment systems that combine front and back-end services. Currently, regulatory barriers to establishing private payment networks are low. This is why the rapid emergence of closed-loop payment networks operated by just a few big techs is a real risk. It would lead to a fragmentation of payments and threaten the public good character of the payment system. In the second scenario, big techs would operate their own payment system, but also issue a stablecoin for exclusive use in the system, like Facebook's Diem proposal. This scenario has even deeper implications. Let me mention three of them. First, big tech's large networks could lead to a rapid and large-scale adoption of stablecoins. Data from payment transactions would enhance their ability to exploit the DNA loop. This could further concentrate market power in the hands of a few and threaten financial stability, fair competition, and data governance. Second, stablecoins could challenge bank business models, especially if those new instruments affect the demand for banks' deposits. As alternative sources of bank funding may be more costly and less stable, this would hamper banks' ability to perform their credit intermediation function. And third, stablecoins could lead to a fragmentation of the monetary system, as they could result in walled gardens. In addition, these funds could be moved around rapidly by users, including across borders. In this type of scenario, stablecoins could erode a jurisdiction's monetary sovereignty and its unit of account through DMization, whereby a large platform denominated in foreign currency comes to dominate digital payments. This would be a new form of dollarization, which is familiar to some emerging market economies. So, if these scenarios appear likely, what should public policy do? To be clear, the goal of public authorities is not to stop useful innovation in the financial sector, but policy should serve the public interest, balancing overall benefits with potential risks. To achieve this balance, authorities should consider three possible responses, which also are not mutually exclusive. The first is managing big techs by adapting existing regulations and oversight. Recent BIS publications have laid out a rationale for regulation in this area and have described policy initiatives in China, the EU, and the United States. There is particular focus on the areas of competition, data governance, and financial stability. Stability. These initiatives seek to address the risk posed by big techs, but also to overcome gaps in existing regulatory frameworks. Let me give you some more details. Competition. Policy is the most active area, and the paradigm shift is emerging here. Authorities aim to preserve market contestability by strengthening ex-post enforcement tools. But they are also developing new entity-based regulation that would constrain business practices of big techs ex ante. Examples are the proposed European Digital Markets Act, the Chinese Platform Anti-Monopoly Guidelines, and a number of legislative proposals in the United States. Last July's UK government consultation on a pro-competition regime for digital markets is a further example. This builds upon the Furman report, about which Jason will certainly say more in a few minutes. Data governance policy initiatives emphasize protecting personal data rights, in particular personal consent and data portability. Many initiatives are modeled after the European General Data Protection Regulation. An important example here is the enactment of the Personal Information Protection Law in China this year. This will change how data can be collected, used and shared by Chinese big techs. Meanwhile, open finance proposals aim to give users more control over their data. In the area of financial stability, individual jurisdictions have followed different paths. Let me take the example of China. In light of the big tech's dominance, it may not come as a surprise that Chinese authorities have introduced a range of financial stability requirements. A key one is that some entities may need to be licensed as financial holding companies under the supervision of the People's Bank of China. This is a novel entity-based approach for regulating and supervising big tech operations. All these initiatives are important steps in addressing risks posed by big techs, and there are more in other jurisdictions. Some introduce activity-based requirements that indirectly affect big techs, others impose specific entity-based obligations directly on them. Going forward, big tech's growth will require additional regulatory responses. Most likely, this will include entity-based rules. Relying only on activity-based requirements will not be enough. A second policy response is to give a further spur to the improvement of current payment arrangements in several dimensions, making them cheaper, faster, more transparent, and more reliable. Central banks could broaden access to their payment systems and improve domestic and cross-border interoperability. This could be achieved through application programming interfaces and the use of international standards. The bottom line is that efficient open payment platforms could prevent dominance by any one big tech provider. The third response may be the most far-reaching. Central banks could introduce digital currencies, CBDCs. As we emphasized in our annual economic report this year, CBDCs present an opportunity to design a technologically advanced representation of central bank money with core features of finality, liquidity, and integrity. CBDCs could also serve as a common interoperable platform that would promote innovation and competition. By offering users as high a level of privacy as feasible, they could provide an additional public good. For each of the components of this three-pronged approach, there is a strong case to strengthen regulatory cooperation. By this I mean cooperation not only among central banks and financial authorities, but also with competition and data authorities. In light of the cross-border nature of big tech activities, such cooperation should also have an international dimension. As you can see, a lot of work lies ahead of us. This brings me to today's conference. This conference offers us a chance to hear more on these issues from both the policy and research perspective. We will hear from central bank governors, leading academics, senior policy makers, private sector representatives, and more. We hope that this conference will open a dialogue across all players, which is indispensable to coordinate financial regulation, competition policy, and data protection policy. Now, allow me to move directly to our keynote speaker, Jason Furman. Jason is best known as the chairman of the U.S. Council of Economic Advisors under President Obama. In this capacity, he was the chief economist to President Obama and was a member of his cabinet. Currently, Jason is the Aetna Professor of the Practice of Economic Policy at the Harvard Kennedy School and the Harvard Department of Economics. He's also a senior fellow at the Peterson Institute for International Economics. Jason has done very influential research in many areas, and he recently spearheaded the Furman Report on unlocking digital competition for the UK government. We very much look forward to hearing his thoughts on the challenges of big tech in finance. Jason, the floor is yours.
Great, Augustine. Thank you so much. And thank you for that just terrific opening. You have just really a spectacular lineup for this conference, all the people that I would want to hear from and learn from. And so I'm not, fortunately, going to give all the answers to this question. Hopefully, a lot of those answers will emerge over the course of the rich discussions today. But what I'm going to do is maybe frame some of the issues, provide some perspective from my work on pro-competition digital regulation, which was not specifically in the finance space, and then talk about some of the issues in finance. Running through my remarks today, there's going to be 4 themes. First of all, not everything is good in traditional finance. There are a lot of problems that need to be solved by innovation. Perhaps chief among them is the millions, tens of millions, around the world, billions of people that are unbanked, that don't have great access to the financial system. For people who do have access to the financial system, fees are often too high. Payments can be slow, payments can be especially difficult across borders, and they can be costly as well. So there is room for innovation in this sector. There is room to solve some of those problems, whether it comes from within the sector, whether it comes from outside the sector, or whether challenges from outside the sector help drive those innovations from within the sector. So that's the first point. We shouldn't lose sight of the fact that it's not that everything's perfect now and we're worried about disruption. There's a lot of things that would be good to see innovation in. The second is I'm going to talk a lot about concerns about big tech and competition. In fact, I'm going to talk a lot more about that than the following point that I don't want us to lose sight of, which is that not everything about big tech is bad. Big tech has produced products that are attractive to a lot of people. It's done that both with scope, but also by integrating a range of features that consumers like and like to use. And so maybe they have something to contribute to the different problems that I outlined in terms of the unbanked fees, the payment system, and the like. The third point that's going to run throughout everything I say is that there are good features and there are bad features. And right now they come bundled together. The good features are the ones I just described, but the bad features are all of the ones that lead, all the ways in which monopolization can lead to abuses, make it harder for other companies to enter, give consumers less choice, lead to less innovation. And so we have to look at this sector and be simultaneously have two halves of our brain working, the part that recognizes the good that might help solve some of the long-standing problems in finance, and the bad that we've been concerned with in other areas. Finally, my last big overarching point is that our goal of whatever we do in policy is to get more of the good and less of the bad. There's not an obvious simple answer to that. It's not as simple as there's enough good that you can just ignore policy altogether, nor is it as simple as there's just bad, and so you want to keep big tech out of finance. You need to figure out more subtly and complicated. What makes this especially complicated is it's much better to get this right up front rather than try to solve it 10 years later. What we've seen in the digital space is the longer you wait, the harder it can be to establish new entrants, to enable competition. There's a certain amount of the toothpaste that just can't be put back in the tube if, for example, you let a company merge over and over again to a monopoly position. So, somewhat awkwardly, I at least don't have the answers. I hope a lot of answers emerge from this conference because I don't think we have 10 years to study this topic and get it right. 10 years from now, the problems will be a lot harder to solve. We need to do it now, but we also need to get it right, balancing the good and the bad. So, those are some of the themes that you're going to hear over the course of my comments. And let me proceed to those comments now. I want to step back and talk about the economics of increased concentration, because I think it's important to have that in all of our heads. Then get to the issues around digital competition. I then want to share with you what I recommended, my panel recommended to the United Kingdom, and they're implementing. So I think it does provide a model for at least part of how to address the issues that we're all concerned with today. And then finally want to talk specifically about the topic of this conference, handling big tech in finance. So let me start out with a very old product. This product is much older than the internet. This product is much older than banks as we know them. This product has been made for thousands of years, and it's beer. These are two beers that a lot of Americans drink. We'll especially see college students on campuses like mine drinking Budweiser and Heineken. These are a lot of other beers. Joe IPA, Elysian, Aphogen, Mort Sudite, Sibel. I confess I don't know most of them. I don't drink most of them. It looks like there's quite a variety of beer out there. But if you look carefully, all of the beers I'm showing you are made by two companies, Anheuser-Busch InBev and Heineken. In fact, you see the large majority of beer consumed in America, and the same is true in many other countries around the world, is made by these two companies. It's made by them in part because they've developed other brands, but in part because they've also acquired other brands. We see this not just in beer, but throughout the economy. We see it in consumer products, cell phone access, internet service providers. We see it in mundane consumer products like ketchup and mayonnaise and mustard. We see it in what producers use, like fertilizer and farm equipment. Throughout the economy, we see more and more sectors with often just two very large players that dominate the sector, either because they've grown or because they've acquired other companies. Now, you don't want to look at something and say just because it's big, it's bad. That was a view in antitrust a century ago associated with US Supreme Court Justice Louis Brandeis. It's a view that's being revived by a group of people that sometimes call themselves or are called neo-Brandeisians. And they have it axiomatic that if something is big, it must also be bad. That's not the wisdom of 50 years or more of thinking on this topic in economics. Instead, the wisdom of 50 or more years of thinking about this topic in economics is that when you interpret greater concentration, it could mean one of two things. It could mean that there's actually more competition, or it could mean there's less competition. More competition, think there used to be one small store in every town. There wasn't actually real competition, even if there were thousands of stores throughout the economy, because in each town there was only one store. Now two big chains open up in every town. They destroy all the small stores. We're sad to see them go. They offered some amenities and benefits. But now there's actually more genuine competition because even though there's only two stores in the whole country, everyone in every town now has a choice of those two stores. Increasing concentration could also mean less competition. If the path to the increased concentration extinguished competitors, enabled greater pricing power or greater ability to just be lazy, rest on one's laurels, and not innovate. So you can't just look at concentration and say whether that's good or bad. You have to ask why that concentration emerged and what the consequences of that concentration is, because concentration itself is endogenous. So broadly speaking, there's some good or natural causes of increased concentration associated with more competition. It could be a superstar firm that's really good at doing something. It makes a product that consumers like and that benefits consumers. It creates, it benefits from global returns to scale. But there's also bad and unnatural causes that lead to less competition, like reductions in. Sorry here. I have a child who yells at me through my Alexa, big tech, intruding on our discussion right here. That bad or unnatural causes of less competition, reductions in merger and antitrust enforcement, or increased regulatory barriers to entry. And there's some that cuts both ways. I'll talk about increasing returns to scale and network externalities. Now, there's a lot of evidence that there's some bad reasons for increased concentration. I'm showing you evidence here from the United States. And this is the number of monopolization cases that are filed under Section 2 of the Sherman Act. So these are cases where a company has market power and it abuses that market power by keeping others out, leveraging the market power into different areas. There's been a diminishment of enforcement. There's also, not showing you data on it, but a diminishment in enforcement of merger rules, and just less funding for the enforcement agencies and courts that have generally been less friendly to both monopolization and merger cases. The second is in many areas there's been a growth of intellectual property rules, patents and trademarks, regulations, and other barriers to entry, many of which protect incumbents at the expense of new entrants. Now, as I said, there's good concentration and bad concentration. Let's just talk briefly about two sectors to give what I think are a good example. Again, data from the United States. The retail sector has grown much more concentrated. The healthcare sector has grown much more concentrated. But you see a real difference between the two. When you look at markups, markups have actually fallen in retail. Think companies like Walmart that have been very aggressive in innovating. Their efficiency has gone up a lot, their output per hour. and they've passed on a lot of that innovation to consumers in the form of lower markups. Then healthcare. In the United States, we've had a lot of hospital mergers. Most cities now have one or two hospitals where they used to have three or four. And that has only increased efficiency a little bit, but it's increased prices quite a lot. In my view, that's happened because the authorities have allowed a set of mergers that they probably shouldn't have allowed in especially the hospital sector, and possibly health insurers in healthcare. So I want you to have this prism in your head that concentration has risen. The concentration rising can be the consequence of something good, like an innovative company like Walmart. It could be a consequence of something bad, like all the hospitals in town merging and raising prices. What about Google, Facebook, and Amazon? Are they good or bad sources of concentration? There's a lot of concentration in that sector. Which are they? I think, as I said at the outset in my framing, there's not a simple answer to this. In part, they've grown because they do great things for consumers. In part, they've grown because they've benefited from rules around mergers, lax enforcement of monopolization rules, and in some cases, some regulatory barriers. And so they are, to me, a combination. In part, they're like Walmart, which was an innovator and grew organically. And in part, they're like hospitals, where the four hospitals got together, raised prices, and didn't increase efficiency in the process. That's what I think makes policymaking in this area so tricky. You want to keep the good and do something about the bad. So let me get now more specifically, dive a little bit deeper into concerns about digital competition. I should say, 3 years ago, I could have given the first part of this talk and given you the economics of increased concentration. But I then would end at there's both good things and bad things in the digital space. We want to preserve the good and do something about the bad. Somebody would ask me a follow-up question as to exactly what I meant by that and how to do that. And I wouldn't have an answer to the follow-up question, which is why I was excited when the UK government asked me to chair an expert panel that put together 4 other people, including lawyer, technologist, and economists specializing in this area, to actually figure out not just how to frame the problem, but what to do about solving the problem. We came out with something, a report that I gave the title Unlocking Digital Competition. Most everyone since then, including Augustine earlier in the session, has referred to it as the Furman Report, which made a set of very specific recommendations about the digital sector. These recommendations were motivated by our analysis, which I'll share with you at a 20,000 foot or maybe 8,000 meter or 5,000 meter level. So Augustine referred to these quickly before in his wonderful opening to today's discussion. There's a lot of features that make digital markets winners take most through a process of tipping. The first is network externalities. I benefit when more people are on a social network. They benefit when I join it. If you want to advertise, you benefit when more people are on the other side of the social network. And all of that tends to lead to a certain amount of scale. The second is there's economies both of scale and also of scope. There's near zero marginal cost, which makes it possible to scale up to billions of people. In some cases, it's happened relatively quickly. In some cases, there's a lot of barriers to it happening that we'll talk about. And also scope, integrating a lot of different features. Just think about the way your phone used to be a telephone, And now it's also your camera, also your GPS device, also many other devices. The third is that data can be a barrier to entry. Google search results are better because so many people search on Google and it has so much data. Facebook can target advertising because of all the data it has, Amazon and what it knows about how you shop, and that can make it difficult. When Google was formed, it was two bright grad students with a great algorithm. It's an open question today as to whether if you have an amazing algorithm that you can develop something without the vast amount of data that others have. This is especially true data as a barrier to entry in artificial intelligence and machine learning. Now, it's possible to have things like AlphaGo Zero that teach themselves from absolutely nothing. But the more common model in AI is to train yourself off of data. And so many of the big tech companies today that benefit from these are most poised to benefit from AI and machine learning. This is not a very equipment heavy business, so capital and brands matter for raising. And there's behavioral features about consumers that do not seem to switch. That you'll see Google paying enormous sums of money to be the default search engine on iPhones because they know even if it takes 2 seconds to change your default search engine, that a lot of consumers won't do it. So these features are present in other markets as well. It's just that every one of them is especially strong in this market and they all combine together. This is resulting in high or rising market shares. In this case, I'm showing you UK data from our report in search, digital advertising, mobile operating systems, and social media. In almost all of these, two companies have increasingly come to dominate. In most of these, the two companies are drawn from 5 companies, of which 2 might be successful in email, 2 or 3 might be successful in cloud, 1 or 2 in retail, etc., etc. Now, just because there's 1 or 2 companies doesn't mean there's necessarily a problem. Economists distinguish between competition in the market, where you have multiple competitors at the same time, and competition for the market. MySpace was overthrown by Facebook. Facebook itself may be overthrown by something else in the future. And so just showing there's 1 at a time or 1 or 2 at a time is not necessarily evidence of a problem. The question is, how much do they face competitive pressures that keep them innovating and that effectively mean consumers have a choice because if they get worse in quality, try to abuse their position, someone else will come along. Well, I am not content with the state of competition for the market right now. A lot of the competition for the market that people point to was in the early days of the internet. It was a bit of a wild west, and the search engine could go from Lycos to Alta Vista to Yahoo to Google. But it's been very stable for 15 to 20 years. A lot of those features that lead to the stability include data as a barrier to entry, for example. So I wouldn't count on there being competition for the market. So the next question is, why is free costly? 0 is just another number. The equilibrium price might be negative. You pay more in cash due to advertising markets. The bigger issues, though, are that you pay in data and privacy. You actually are paying for these services. And then perhaps the biggest issues of all are the ones that we can't directly observe, we can't definitively document, but we worry about lost quality, variety, and innovation when there are fewer choices. Most importantly, Google and Facebook, and the same could be said of Amazon, are not just like Walmart, a company that grew and grew as it opened new stores, something we call organic growth. Google, most of the main components of it were acquired. In some cases, these were acqui-hires, but in many cases, it was the technology and the platform itself. Facebook combines three of the world's four largest social networks, not because it invented those social networks, but because it bought two of them. So, what do we do about this? In the UK, what we recommended and what the UK is pursuing is the establishment of a digital markets unit. The digital markets unit would have three functions. The first is a code of conduct, the second is data mobility and open standards, and the third is data openness. The code of conduct is similar to existing antitrust rules. It's principles for businesses with strategic market status, like access to designated platforms on a fair, consistent, and transparent basis. You can't keep some people off your platform. If you're a company that's a bottleneck company that people need to go, other companies need to go through. You have to do prominence of rankings and reviews on a fair, consistent, and transparent basis, and not be unfairly restricted from or penalized from utilizing alternative platforms or routes to the market. You can go elsewhere. Importantly, this would only apply to large bottleneck companies. This would not apply to medium-sized companies, not apply to small companies. So there'd still be a lot of flexibility for innovation and change. It just would be if you're close enough to monopolization, this would kick in. Similar to existing antitrust rules, and ideas like this have been proposed both by the European Commission and also passed as legislation out of a committee in the House of Representatives in the United States. The second part is data mobility and open standards. Here we took a lesson from open banking in the United Kingdom, where they required, I think it was the 7 or so largest banks to open up their APIs, let other companies build on top of it. This both has direct benefits for consumers. Consumers like to be able to move their data. It lets them multi-home, use more than one platform at once. It lets them switch between platforms. A certain amount of this, the companies will correctly tell you they're doing on their own because their consumers want it, but they're doing suboptimally too little of it. You can't just pass a law to say, go ahead and do this. You need to very carefully go issue through issue to balance considerations of privacy, to make sure you're still leaving room to innovate and not just locking in a static standard. And so it really does take a standing body, a regulator, like a digital markets unit, to execute on something like this. Finally, data openness is addressing the data as a barrier to entry. There's a lot of ways to do this, whether it's making lag data available, making real-time data available, including data in data trusts, anonymized formats through the government and the like. Again, you can't just pass a law that says you should have open data. There's a lot of data that shouldn't be open for privacy reasons or because you want an incentive to collect it. You need to judiciously go through each use case. So the United Kingdom launched the Digital Markets Unit back in April, and it's operating within the CMA, the Competition Markets Authority, and similar ideas are underway in the rest of the world. Let me now turn, for my conclusion, back to where I started with my framing about how to handle big tech in finance. The internet, I should say, was supposed to usher in an era of competition. People thought anyone could start a company in their dorm, low fixed costs, zero marginal costs, can take advantage of the long tail. So 20 years ago, there was this hope that this would be some new, much, much more vigorous form of competition. Instead, we've actually gotten more concentration. I think that's what we have to fear in as big tech enters finance as well. At first, we thought it would be lots of cool little fintech startups. There have been some cool little fintech startups, some of which have grown to be quite large, like Square and Stripe. There's other cool little fintech startups, but a lot of what we've seen as we've allowed tech more into finance has been a rise of big tech in the financial space, bringing with it both the good and the bad. So there's a fine line between leveraging market power in one sector to dominate another versus providing benefits to consumers. If they're already holding your phone, why not use your phone for payments? If they already have a network of friends, why not build on that network of friends for payments? Entering finance is different from selling books. Amazon competes with small bookstores, but big tech is competing with big finance. Big finance itself often faces insufficient competition, and that has within finance led to some of the problems like unbanked, slow payment systems, high fees, and the like. So this may be helping us solve a problem in another sector, and so we want to welcome as much of it as we can. But there's also concerns about regulatory arbitrage. The cultures of these two sectors are so different, and the cultures of public policy. Tech is the ultimate unregulated sector. The philosophy is move fast and break things. You cannot, in the banking system, move fast and break things. If you do that, you can have global financial crises and disasters. And so the last thing we want to see is tech succeeding not because it has better products that it solves for the unbanked and payment systems, but because it's arbitraging its non-regulation to succeed in a highly regulated sector. So where does this leave us? I think there's three goals for public policy. The first is to keep as much good competition that benefits consumers as possible. They're succeeding based on superior products and increased competition. That's a wonderful thing, and we should welcome it. The second is that we need, rather than this be the wild, wild west of unregulated lack of competition, we need regulation on the digital side, along with tougher merger enforcement, which I didn't talk as much about, but it's an important part of the equation as well on the digital side. To have code of conduct, interoperability, and limit growth. And the digital regulation would be focused on competition across the board, including competition in the payment space. Then we also, from the other side, need to maintain regulation from the finance side so that big tech doesn't engage in regulatory arbitrage. This is not a detailed template of exactly what to do about big tech in digital space. I don't know exactly what to do, but I'll end where I began on that it's hard to get this right, but it's going to be even harder to clean up the errors later if policymakers get this wrong. So I hope by the end of today, the answers to these difficult and important questions have emerged. Thank you very much.
Well, thank you, Jason. You've laid out the issues really well. I hope we can get in a couple of questions, actually. I think that was a very rich presentation. So for those of you who have joined the call on WebEx, please raise your virtual hand. Perhaps we can, Jason, just collect a couple of questions. Benoit Corre, go ahead with your question.
Yes, hello, Jason, and thank you very much for a brilliant speech. Lots of food for thought. I have a sociological question. which is how do you make financial regulators and competition authorities work together? They hardly speak to each other. So how do you create a network, an architecture where all these different regulators will work together?
So Jason, before you start answering that, let me just squeeze in Stein Klaassen. Stein, go ahead.
Yeah, thanks, Jason, and thanks very much for a very nice speech. I had a question on data privacy. You didn't talk as much about it, but of course, if we have the big techs get access to, let's say, payments data, they suddenly know a lot more about me than they used to do in the past. And it's really very valuable data. So all of what you described, could it then suddenly not accelerate and make the big techs even an unfair competitor in many fields? You didn't get into that yet, but issues about financial stability then probably come to the fore as well. But just on the privacy, maybe some views of how to organize that.
So Jason, if I may also just squeeze in a question of my own. I read the Furman report. I think it's a very impressive report. I mean, one thing that really struck me was this idea that the traditional approach of using investigations and ex post remedies may not be really the right approach for a really fast-moving area like this. I mean, what is your sense of how we should approach, the regulation and enforcement of the rules? I think that would be, I think, very much relevant for the discussion later today and also tomorrow. So over to you.
Great. Maybe I'll take the questions in reverse order, starting with yours, which I think was probably the easiest because I've thought about it before. And then the answer to Benoit's question is going to be to ask Benoit the answer to Benoit's question because he's thought about it before. Yeah, that's a lot of what we came to is that the ex post enforcement leaves a lot to be desired in a sector where things are moving so quickly. If you wait, if it takes you 8-10 years for your antitrust case to work through the legal system, the landscape has entirely changed. The possibilities for competition aren't there. There's some downsides for companies too in the ex post enforcement because it creates uncertainty about what they are allowed to do and what they aren't allowed to do. And so our view, pro-competition regulator, was about shifting to more ex-ante enforcement, fleshing out the code of conduct, providing details about what you can and can't do. To some degree, some companies have welcomed that and said, they're happy to obey the rules. They just need to know what the rules are. To some degree, obviously, you hear a lot of the predictable complaints that you'd otherwise get. But I think, and I think the arguments for ex ante might even be stronger in the finance space than they are elsewhere. To get to Stephen's question, yeah, I should have talked more about privacy. I think to some degree, competition and privacy are complementary in that if consumers value privacy, they'll do something about it. So, for example, there are two mobile operating systems, Android and iOS, and Apple advertises heavily about privacy associated with their product, and their product, I think, is better at privacy than Android. And so consumers that like privacy, that could be one reason they choose to make a choice to get an iPhone rather than to get an Android device. So I think there's some complementarity between greater competition and privacy. But I think it's also the case that competition policy and competition regulation only works in areas that consumers care about. And that if consumers don't care about something, it can't work. The most extreme examples are, content moderation and using platforms to organize genocides, using platforms for child pornography. Competition doesn't solve those problems. And so privacy, some of it's going to need to come from a competition, just almost a human rights perspective. To get to Benoit's question, which is about the culture of these two industries, I would love to hear Benoit, and hopefully you'll address it on your panel later today, how you do it. I don't know the answer to that. I think part of the answer must be asking the question itself. In the UK, for example, the Bank of England has a competition mandate as one of its mandates. The Federal Reserve does not have a competition mandate. Now, I've seen this in the privacy space, where again in the UK, the privacy regulator doesn't have competition as part of their mandate. And you'd sort of like that to be part of it. So they ask the question, oh, if we're making this privacy rule, are we creating a barrier to entry that actually reduces competition? And you'd want them to ask that. And on the other side, you'd want the people doing competition to ask what impact it would have on others. So I think part of this may be assigning secondary mandates. Part of it may be in personnel, but I don't have a confident answer for you, Benoit. I think that that's a super important question.
Well, thank you, Jason, again for starting us off on this very positive note. Let's close the session there. We'll take a couple of minutes break. We'll resume at 2 so that we can actually get the setup ready for the next session. But Jason, thank you again for giving us much food for thought and getting us off to a great start. Thanks.
Thank you for including me, and I look forward to the discussion.
Great. I can read if you want. Yeah. Well, welcome back. Welcome to the first research session of the conference, which looks at the implications of the entry of big tech firms into finance. As we touched on in the keynote by Jason Furman, the business model of big tech firms is built around the data that is generated from the direct interaction of users in their existing business lines. And this interaction gives rise to network effects where the more users flock to a particular platform, the more other users are attracted to that platform as well. And these network effects can give rise to market power if they result in so-called walled gardens. And now, in this session, we will examine the implications of data and the network effects for financial services. And we have the two perfect speakers for this session. Both straddle theory and practice. Both speakers started out in academia, but they're now well known as practitioners, really at the top of their games. The first is Jorge Padilla. He's a senior managing director of the consulting firm Compass Lexicon, and is one of the leading experts on competition issues, especially in the European context. And he's the author of many influential academic papers in industrial organization. And he's going to present his paper, Big Tech Banking, which focuses on the implications for the banking sector, and in particular, the future shape of the banking sector itself. Our second speaker is Karen Croxon. She's an economist by training. She also started out in academia. She's now in the official sector as the head of research at the UK Financial Conduct Authority, where she leads a team of economists and data scientists on a range of issues that are really very relevant for the for our conference, including consumer protection and business conduct. And Karen's going to present her paper, including with some BIS co-authors, on the public policy implications of platform-based business models in finance, with a focus on financial inclusion. So we'll kick off with Jorge. Jorge, please, you have the floor.
Thank you very much, and thank you for the invitation. It's a real honor. So as you have just mentioned, I'm going to be talking about the positive and the negative effects of the entry of big tech platforms into banking. And I want to talk also about whether there are ways in which we could regulate big tech so that we can balance those positive and negative effects to the benefits of society. In particular, therefore, I'm going to structure my presentation in two parts. First, I'll talk about the effects on competition and financial stability of the entry of big techs into banking. And the second part and last part of this presentation will focus on whether and how to regulate big tech insofar as they operate into banking. So let me go to the effects on competition and financial stability. As it has been mentioned already in today's session, big tech platforms possess significant competitive advantages that they have used and can use to leverage onto other markets, and in particular that they can successfully use to leverage into retail banking. They have large installed customer bases, they possess powerful brands, they have very significant earnings, their capitalization is striking, unfettered access to capital markets, but above all, and most importantly, superior information about consumers' preferences, habits, and conduct, data. As regards banking, they also benefit or may benefit from a regulatory asymmetry when competing with established banks. And I'm not referring exclusively to the fact that traditional banks will be regulated from a prudential perspective, but also that traditional banks in many jurisdictions, certainly in Europe and in the UK and in other jurisdictions, are now required to share considerable amounts of information with third-party competitors. Whereas big tech platforms are, as of today, requested to share data, but only to a much limited extent, only when it is technologically possible, and in ways that do not require constant access to that data and do not require that access to be mediated through application program interfaces that make the data sharing very easy. Not surprisingly, big tech platforms have grown their share into banking, in particular in two areas, payment systems and consumer and SME lending. Their entry is likely to have positive effects on competition, is likely to enhance competition, at very least in the short term, and to the benefit of consumers. They will innovate in terms of the products that are available and may reach out to unbanked customers that otherwise would not be included into the financial system. They may enter in different ways. They may enter as intermediaries in direct competition with incumbents. They may enter as marketplaces that get in touch, consumers, borrowers, with the banks. One way or another, what they are likely to do in the first instance is to provide more choice to consumers. And to the extent that they have and possess significant amounts of hard and soft information, they may dilute the competitive advantages of incumbent banks, which stem mainly from the possession of soft information about their borrowers, and in so doing, they may lead to more competition. Not everybody agrees, however. A very recent and interesting paper by a few authors from the University of Chicago indicate that the effect on competition may depend on whether or not there is a level playing field from the viewpoint of the data from borrowers that traditional banks and big tech platforms possess. If they operate on a level playing field, meaning that they have access to similar data, then the entry of big tech platforms ought to have an unambiguous positive effect on competition. But if on the contrary, the big tech platforms have better data and are better able to process that data in order to assess the quality of the borrowers, then the result of their entry may be less competition, even in a static sense, as a result of market power being in the hands of these big tech platforms with superior skills and information, and traditional banks being unable to exert a proper competitive constraint due to their inferior data holdings. Whatever we think about the short-term effects of big tech entry into competition, we need to look forward and consider the potential long-term effects. We have seen in the past, in other industries, how the entry of big tech platforms has initially disrupted the traditional business models and increased competition and enhanced choice. But we have seen also that over the long term, the big tech platforms have managed to monopolize those markets, and then the good deal for consumers was over. The concern here is about the long term. Would the big tech platforms be able, like they have done in other industries, to monopolize the banking markets where they participate, and in particular, not just payment systems, but also the origination and distribution of loans to consumers? There are reasons to think that they may do so, because these platforms have all the assets that I mentioned before, and especially information about borrowers that banks may not have. Traditional banks then risk being transformed into commodities, into narrow banks that basically play no role in the origination of distribution and limit themselves to fund the loans generated by the big techs. And if so, this would be particularly troublesome, because it is payment systems and it is the origination and distribution of loans to consumers and to SMEs that provides, or they represent, one of the main sources of profits for traditional banks. These are the areas where the return on capital employed exceeds the cost of capital. And therefore, if banks are cornered in this particular way, they may end up being unable to survive. And that may accelerate the process of monopolization of the markets. Now, you may say this is too dramatic. Banks enjoy a lot of competitive advantages. They also have install bases. They have reputations. They have powerful brands. They may be more trusted than big techs by depositors and borrowers and consumers. And they have lots of soft information. But maybe we should worry nonetheless, because other incumbents thought that they also were well protected against the entry of the big techs, and they did not. The experience shows that big tech platforms have been able to escalate their businesses quite rapidly, very quickly, because of their ability to tailor services to consumer preferences. These considerations are not relevant exclusively from a competition perspective. They have prudential implications. The entry of big tech platforms may have a significant impact on financial stability. If I'm right, and the result of their entry may be that banks are become narrow banks and that the origination and distribution of loans is in the hands of the big tech platforms, that involves a decoupling between origination and funding that has proved troublesome in the past. From the savings and loans crisis to the crisis in 2008, we have seen that when those that originate and distribute have no stake, has no real stake on the loans that they originate, moral hazard is a real issue. And it's not just that these platforms may not have proper incentives to restrict credit and monitor the nature and quality of the projects that they fund, to screen loans properly. It may be also that banks in this new scenario also see their incentives to screen reduced. Moral hazard is one of the problems, but there may be also problems related with adverse selection. Big tech platforms may have incentives to bring into the market borrowers of low quality, borrowers that are not credit worthy, because of the sales that the ancillary sales that these big tech platforms may make with those borrowers. Originating loans because they can sell them products. Originating loans because they can provide them with other services. And because of their superior information and their superior ability in order to process that information, they may end up leaving to banks those borrowers that are of inferior quality, generating therefore a shift risking issue that may undermine the viability of the traditional banks. So what do we do? Very quickly, should we ban big tech's entry? I think that that would be a mistake. As Professor Furman mentioned before, it's not that everything is okay with traditional finance or traditional banking. There is market power, and there are concerns about market power, and big tech's entry may promote competition. But there is a bad side to big tech's entry. The potential relaxation of competition in the short term, the more risky relaxation of competition in the long term, and the financial stability problems that I mentioned before. How do we deal with this? The status quo doesn't seem to be an option. Some people advocate, in particular traditional banks, for activity-based regulation. Same activity, same regulation. Constrain big techs in the same way that you do constrain us, they call regulators. They said to regulators. A recent sets of papers indicate that perhaps we should look for a mixed approach with some activity-based regulation and some entity-based regulation. I think that an element of entity-based regulation is particularly important, not only because in some activities traditional banks may be different, that they will take deposits, they will be banks, whereas big tech firms are unlikely to get into that area of business, but also because big tech platforms have specificities that need to be tackled directly. And in this respect, I want to conclude by referring to two types of intervention that I consider central if we want to make sure that we take the most out of the entry of big tech platforms into banking and limit the potential risks of such entry. And these two interventions concern data, because this is the key dimension of superiority that may lead to the problems that I mentioned before. And one possibility is actually to mandate big tech platforms to share some of the data that they possess, so that we generate a level playing field informationally between traditional banks and big techs. And of course, this could raise all sorts of privacy concerns, and I'm going to leave them aside. But the important thing is that if we mandate data, we need to do it in such a way that that data sharing is effective. GDPR is not enough. We need to be more intrusive. We need to do with, if we go in this route, we need to do with big techs what we meant to do, or we are still trying to do, I guess, or striving to do with traditional banks, which is to get them to share on a continuous basis, on an easily accessible basis, through standardized APIs, the data that they possess that is relevant for competition in these markets. The DMA was mentioned in the initial presentation by Agustin, and the DMA goes to some extent in this direction. But as I will argue in a second, it's likely to be insufficient. It is just requiring banks to share data and facilitate the portability of data, and also to facilitate the sharing data that is generated in their platforms, but by banks or the users. But it includes too many caveats. Perhaps concerns about privacy explain those caveats, but these caveats may limit the effectiveness of this remedy. An alternative to data sharing is data unbundling. Is to say, look, okay, fine, we're not going to require you to share data that you have collected through your platforms, say through your mobile operating system, through your search engine, through your social network with the banks. But what we're going to do is we're going to restrict your ability to combine personal and transaction data from those platforms with the personal and transaction data that you may get from the banks or you may get while conducting your financial activities. So that we put you at a level playing field with less data. Data sharing is everybody's on a level playing field, but with more data. This would be, you are not going to be able to leverage your data superiority in adjacent markets into banking. Now, in the interest of time, I'm not going to get into all details. This has also problems and difficulties. On the one hand, we may be incurring into what is called an efficiency offense, preventing the combination of data that would allow big tech banks and also traditional banks to offer better services. But the main problem is how we implement this unbundling. Precisely because we may be concerned about restricting the combination of data too much, it is likely that the regulation goes in the direction of saying you shouldn't combine data unless there is consent. And that's precisely what the DMA in its current formulation, the DMA proposal, does. But what is consent? And can we rely on consent? The answer, in my opinion, is no. I can consent sharing that with my data. I can consent that my data from my bank is combined with the data that is collected from a platform. But that does not only have implications for myself, it has implications for lots of other people that have socio-demographic characteristics like mine. They are data externalities. Consent is problematic if the platform in question has a dominant position or a super dominant position. If I'm told, unless you give us permission to combine data from this platform with your financial data, you're not going to be able to access the platform. And that platform is essential for my communication, my socializing, etc. I'm likely to provide consent. Consent may not be enough. And therefore, the effectiveness of this data unbundling proposal may be limited, pushing us again in the direction of data sharing. One last comment. It seems to me that we need regulation to ensure that there is a level playing field between big tech platforms and banks, so that we can take advantage of the entry of big tech platforms in a sustained way. But we need to be careful not to over-regulate. If we do, big tech platforms may shy away from entering into these markets, may think it is not worthwhile to enter into finance if the result of this is that I need to distribute, to share with lots of people the data that makes or ensures that I retain a leadership position, a leading position in my platform. If they shy away from entry, we may end up in the worst of all possible worlds, which is one in which the big tech platforms and the banks do not compete, but they each stay in their separate markets, collaborating, even sharing data, but not competing. That would be the terriblest scenario for me. And one that I don't think is pure science fiction. I don't know what has motivated Google's recent decision a couple of days ago of scrapping its plans to offer bank accounts to users. But there are those that say that one of the reasons is that it fears regulation. There is an alternative explanation, which is that they do business with banks and didn't want to annoy some banks because they were collaborating with others. But the risk that the threat of regulation deters entry is something that we also need to worry about. So unfortunately, life is not easy, and we need to find the golden middle point to regulate, not too little, but not too much. Thank you very much for your attention.
Thank you, Jorge. That was very clear. So why don't we collect the questions at the end, and we can move straight to Karen. Karen?
Thank you, Hyun. Let me just see if I can share this.
The slides are up.
Oh, they're up.
Yeah.
Wonderful. Thank you so much. So thanks so much, Hyun, and thanks, Jorge, for a truly fascinating presentation. Thanks very much for the invitation to be here. It's really great to be part of this event today. So today I'm going to be presenting fairly briefly a forthcoming paper on platform-based business models and financial inclusion. This is joint work with John Frost and Leonardo Gambacorta at the Bank for International Settlements, and also with Tommaso Valletti at Imperial. Tommaso previously served as the chief competition economist of the European Commission's Directorate General for Competition. I should just say up front that these are very much the views of ourselves as the authors and not necessarily those of the BIS, the FCA, or the European Commission. So what do we do in the paper? Well, briefly, we look at the growth of three types of platforms in finance: fintech firms, big tech firms, and also incumbent financial institutions getting into this model. And then we step back and ask what this means for financial inclusion potentially, but also for market structure. It's very much an applied research paper. We're deriving insights from the literature on platform economics and also from empirical work on digital finance. And really, our hope is to inform the dialogue on policy. We're looking to promote financial inclusion, but also thinking about protecting consumers, promoting good competition, financial stability, and other key public policy goals. So let's just jump straight in and talk about the types of platforms we see in financial services. So we see broadly three types in digital finance. The first are fintech platforms. Now, these are often focusing on a specific financial service. It could be payments, credit, insurance, wealth management. They're really bringing together and matching two groups, such as users and merchants, or perhaps borrowers and savers. A second type we see are the big tech platforms, like those listed here in the middle column. These are firms whose primary activity is really digital services such as social media, e-commerce, internet search, telecommunications, could be ride hailing, and then who expand from there into financial services. And finally, there are some incumbent players in financial services now adopting more of a platform-based business model as well, making greater use of big data and automation. In many cases, these incumbents are offering third-party services to their clients, such as digital payments, credit insurance, perhaps wealth management. And the model is sometimes called banking as a service here. It really entails quite a change to the traditional business model, with the incumbent now functioning more as a matchmaker in some aspects of the offer rather than a traditional intermediary. So what defines platforms is really that they operate in these two-sided or perhaps multi-sided markets. Here's a really simple representation. Whereas in a conventional market, you have buyers and sellers. Here you have buyers, sellers, but also the matchmaker in the middle, the platform. And we see platform-based business models now in a number of sectors, of course, of the modern digital economy. Examples include ride-hailing apps, matching drivers and passengers, perhaps a hospitality platform bringing together apartment owners and tourists will be familiar to many of us. Over in financial services, it could be borrowers and savers on an app. It could be retail clients and financial service providers on social media, search, or e-commerce platforms. Now, a key thing to note is the potential for externalities, and Hyun, you touched on this already. The value to a participant of being on the platform can increase significantly with the number of others on the other side of the market. So as this network scales, you get a lot of good things happen. You get a high probability of finding a trading partner, finding the right match, and so on. Now, digital platforms in particular may be particularly effective at some of this, about using that data and technology edge to overcome search and matching frictions. We may see here some quite strong positive network effects. But then, of course, there's also the risk of some concentration. Perhaps these markets tip over in favor of dominant platforms, and that's a consideration discussed in the literature. Now, the literature points to a few ways of countering concentration where platforms are concerned, and we discuss a few of these in the paper. One is that competitors may pursue differentiation strategies. This could moderate a bit of a winner-takes-all or winner-takes-most outcome if you think of, say, a smaller platform potentially offering better quality services to the market or catering to particular consumers or consumer groups. So you may then see multiple players coming into the market or staying in the market for this reason, although worth saying that there may not be a huge amount of competition for any one individual user or segment. Multi-homing can help here a lot. So this is where users might utilize more than one platform. This could play a key role. So think about multiple meeting platforms that many of us use. You've got WebEx, Zoom, Hangouts, and so on, and we switch between them. This kind of multi-homing can really cut through concentration, can allow some competition among platforms. But in the real world, there may be some limitations to multi-homing and the effectiveness of that if you have things like behavioral barriers to having more than one subscription, to really getting out there and comparing these platforms actively and switching. It may also be that only one side of the market can really multi-home and not the other. And finally, of course, regulatory intervention could also be used to counter concentration. In particular, we call out platform interoperability, where the users of one platform can interact with the users of another. This could play a similar role to multi-homing, helping us societally to preserve those positive externalities of platforms while still ensuring that these are really available to all at the industry level and don't accrue uniquely to a single firm. I'm going to get back to interoperability just a bit later. So what's really unique about...
Can I just jump in here? I think we need to synchronize the slides. Maybe
okay.
If you share your slides on WebEx, I think we can also synchronize here.
Okay. I'm so sorry. I kind of had lapsed into thinking I was sharing them. Yeah, just hold on a moment.
Yeah, sorry to jump in.
No problem. It's a good intervention. Thanks. So, okay, I'm sharing now. Let me know if this is okay for you.
Perfect. Thank you. Thank you, Karen.
Okay, great. Thank you. Thanks for that. So what's unique about digital platforms? Well, quite a few things, and this is obviously something with complex considerations, and we mustn't lose sight of the positive. But so first, digital platforms may harness powerful data and technology to lower the cost per user. These powerful network externalities can kick in. There may be then some gains from greater financial inclusion and some really value creating innovation. But there are some potential other considerations as well to get into. So the panels in this picture, I won't go through it in great detail, but really what we're doing here is we're comparing for a bunch of different market structures, consumer surplus, monopoly surplus, and total welfare to really explore the potential effects of a possible digital monopoly that could emerge. So in the first panel here on the left, you just have classic perfect competition, lots of firms, they're all price takers, the market's clearing nicely at point A with this downward sloping demand curve where that meets the horizontal supply. And there's this single price, PC for those with good eyesight, that is equal to the marginal cost. Now, lots of consumers here are enjoying a surplus because they value the product at more than the price they actually need to pay for it with this uniform pricing. And we've got this total consumer surplus here in the blue triangle. Now, if we shift into the second panel, that's just traditional monopoly. We've got a monopolist there maximizing profit, setting a somewhat higher single price, PM. And here we see that price is a bit above marginal cost. The quantity overall is lower. We may lose some financial access off the back of that, but still we see some consumer surplus, the smaller blue triangle now in the second panel, but also monopoly surplus, and this is the red triangle, the red rectangle. So what happens in a digital monopoly? Well, let's explore a few potential effects. Looking first at panel 3. So here, the digital monopoly harnesses data and technology to lower the cost per user, but it also uses big data and sophisticated algorithms to predict individual willingness to pay and implement very powerful price discrimination. So here we can have two effects. Firstly, the overall triangle here is expanding and financial access has grown. Some of those previously priced out of the market can now get in there and consume in a way that is affordable to them. But the powerful price discrimination I described means that the monopoly, the digital monopoly, is capturing the full social surplus generated here in this very stylized extreme case. So to be clear, this outcome is very efficient actually from an economic point of view. But when each of us pays exactly our willingness to pay for, say, a flight ticket or an insurance policy, we may not be entirely thrilled about it. And so the pie has grown overall, but we're also seeing an element of value extracting innovation in this scenario. And then finally, looking at this far right panel 4, a further possibility that we consider in the paper is that a digital platform may also use big data and analytics, maybe a dose of behavioral science to understand and exploit consumers' behavioral biases, possibly even to manipulate preferences. Now, this could lead consumers, say, to overestimating the benefits of the service to them or paying more than their reservation price for it. And perhaps there's an element of sharing valuable personal data to access the service, which is not so well understood. So in this case, and look here at the pink slither, if you can, we're saying there's something of a perception gap that can arise and some potential detriment to consumers. The overall outcome is inefficient here. There's some overconsumption of the service, and there's a sense in which there's some value destroying innovation going on here with all this data and technology. And I think this links very, very well to some of the points that Jorge was making about predicting consumer behavior, habits, and preferences, and both the great things that can come from that and some of the risks we have to think about. So. So let's move on into what we're actually seeing in practice. I'll just spend a few minutes on some of the evidence. So this slide, I think you've seen already in Jorge's presentation as well. So we can confirm with some actual evidence that platforms scale fast. Big tech credit has expanded particularly rapidly, with total lending volume hitting nearly $600 billion globally in 2019. The early indications are that it grew further in 2020 during the pandemic, and that was even as fintech credit shrank. And in some markets like Kenya, China, and Indonesia, big tech credit is an economically significant share of overall credit. Digital payment apps are seeing rising adoption around the world. In advanced economies, it's especially the fintech apps like PayPal and Venmo that are taking off. Over in emerging market economies, it tends to be more the big tech apps like Alipay, WeChat Pay, Google Pay, and PhonePe. In many cases, the innovation has been associated with some progress in financial inclusion. Here we show just the percentage of adults with a transaction account and how this has developed over time in different regions of the world. Here in the UK, we're seeing some positive signs about financial inclusion from things like indicators in our FCA Financial Lives survey. Got a couple of plots from that here. In the left panel, we're looking at the share of adults using mobile apps for day-to-day banking. We can see that this rose across the board between 2017 and 2020, with relatively larger gains for women. Usage has also increased among adults with characteristics of vulnerability in the areas of health, life events, resilience, and capability. And over on the right-hand side, we see the share of adults who are digitally excluded fell in the same period. And there have been some gains in digital inclusion among older cohorts too, although we do still see large shares of users in that demographic. The over 65s are digitally excluded. So this remains an area of ongoing concern. We're also seeing a tendency towards greater concentration. In China, there's a duopoly in mobile payments. Elsewhere in payments, we see mergers and acquisitions activity taking off. Here in the plot, we're showing M&A activity by selected global payment platforms, and we see that this has proliferated since 2017. There's a really interesting recent paper by Kamapali, Rajan, and Zingalis, which shows that the mere threat of acquisition may reduce VC funding for new firms. And this is because investors anticipate that startups will be bought out before they can really build a sufficiently large network. So this is one of many potential competition concerns. And as mentioned already, some incumbent financial institutions have moved towards more of a platform-based model, or if you like, banking as a service. They're offering third-party services to users and acting as a matchmaker. So in this case, we'd expect to see some shift in their revenue base towards fees and also some stronger investments in digital technology. Here on this slide, we take a look at that. There isn't really an objective classification that we can use to look at this, but we're looking here at non-interest income of platform-based banks, and we see that this is higher than their non-platform peers. The expenditure on technology is also higher. So in both these slides, it's about the red line being significantly above the blue line. So overall, we argue in the paper that the same forces that allow platforms to enhance financial inclusion, potentially bring a huge amount of benefit, can also bring a risk of tipping of markets, the potential for some market dominance. If our goal is to harness the benefits from innovation and platforms for things like efficiency and inclusion, whilst also mitigating the broad range of risk, then it's fair to ask what policy can really do. In the paper, we discuss three approaches to this. The first option we discuss is simply applying the existing rules. Many authorities explicitly adopt a same business, same risk, same rules approach, where they're dealing with new entrants or incumbents. So this would mean applying the same licensing, regulatory reporting, and so on provisions to both fintech and big tech, for instance. Where needed, the authorities might try then to fit new models into existing regulatory definitions and categories. Now, there are some challenges potentially with this. Financial regulation and competition law may not always be agile enough to prevent concentration. There can be trade-offs between policy goals that need to be worked through. New platforms, particularly big techs, may have informational advantages. Some of this could relate to the asymmetries in data regulation that I believe Jorge referred to already. And there's the potential for some systemic importance here as well on the part of the big techs. A second approach is to then adapt the existing regimes and adopt some new rules in financial regulation, data protection, and competition policy. So new financial regulation and competition rules may be explicitly tailored to platforms. I've got some examples here on the page. It might be some new licenses, such as those we're seeing for virtual banks in South Korea, China, Hong Kong, and Chinese Taipei, enhancing competition through APIs and other tools to enhance data portability. Examples include the UK and EU open banking here, and also developing new ex-ante regimes, such as the Digital Markets Unit here in the UK. Enhancing interoperability can be particularly powerful. In the paper, we have a box on the experience with telecoms in the EU on this, and data protection rules, though they're broader than financial services and cut across many sectors, they can impact on competition and financial stability. And we've got GDPR and a data minimization principle then, which limits the volume of data collected. There can be some considerations there for other goals. And over in California, we've got the California Consumer Protection Act defining sanctions for data breaches that would also be relevant for those with where financial data is concerned. Finally, but not necessarily mutually exclusively, we're talking in the paper about the role of provision of public infrastructure here as a further option. Private sector platform services are often built on a public sector infrastructure. We've got some examples here on the page with government ID initiatives and enhancements to real-time gross settlement systems and retail fast payment systems. Public infrastructures could help facilitate entry and bring about greater competition between the platform providers. You could think of retail central bank digital currencies in this light as well. So just to wrap up, as noted already, platform-based business models are changing market structure in financial services. Fintech and big tech entrants are booming. Some incumbents are adopting more of a platform model as well. We know from the literature on platform economics that platforms can be highly scalable. Platforms may collect huge amounts of data across a variety of contexts and business lines. There can be significant network effects and economies of scale and scope, and huge potential, value creation here from a societal point of view. But the same forces can support both financial inclusion, but also potentially some tipping and concentration in markets to really capture the benefits for goals like efficiency and inclusion and mitigate some of these risks I've talked about to fair competition, data protection, financial stability and beyond. Then authorities can choose between three approaches: apply existing rules, adapt existing regimes and adopt new and more forward-looking rules in some of these areas. And thirdly, not mutually exclusively, provide some public infrastructure where examples might be digital ID and faster payments. So thanks very much for listening. And I would say as well that in the paper, there's much more discussion, but I'll keep it short in the interest of time. We discussed how the latter two approaches may be more promising in this scenario, but really regardless of the approach chosen, we also emphasize that it's important for central banks and regulators with their mandates to work very closely with competition and data protection authorities, very much building on the existing mechanisms. So thank you for listening. Really look forward to joining Jorge and Hyun and you all and taking any questions. And I should say as well that my co-authors, John, Leonardo and Tasso, are also here and may well want to chime into that discussion. Thank you.
Thank you, Karen, and thank you, Jorge, for that very rich discussion. So let me open the floor and invite questions. Let's go first to Fernando Restoy, and then we'll go to Bert van Roosbeecker. And then we could also invite Karen's co-authors later at the end. So Fernando, the floor is yours. Could we get Fernando on the screen?
You hear me now?
Yes. Go ahead, Fernando.
Good. Thank you, Hyun. Thank you both speakers. Very, very insightful presentations and very sensible policy conclusions. Let me ask maybe a couple of questions to Jorge. Hello, Jorge. Good to see you again. First, I mean, you have a very catchy title in your presentation, which is something like Big Tech banking. It's interesting because actually you were speaking for 25 minutes about big tech banking. You cannot mention the word deposits. When you think about banks, in principle, you will think about these entities that take deposits and then they do other things like credit underwriting, payment services, and whatever, right? But deposits should be should be sort of part of the core definition of the bank is about, right? And it's something that, in principle, banks do. Most big techs don't. So, and this may actually have some implication in terms of the analysis that you basically shared with us. First, because when you think about the competitive advantage of banks vis-a-vis, say, big techs, non-deposit taking big techs, obviously, is precisely that, banks can leverage on the complementarities between, deposit taking, credit underwriting, and particularly payment services. So when you actually describe how this competitive position could evolve over time, and take into account that other players are now competing with banks in some activities like payment services, for instance, do not mention whether, or you are not explicit about whether you feel that this complementarity between deposit taking and other activities will continue to be relevant in the future. That is key. To understand, what is the scope for basically for the regular commercial banks to disappear from the marketplace as a consequence of the new players, right? Also, the idea, the point, the extent to which big techs do not take deposits also have implications in terms of the financial stability implications of the financial activities they perform. To the extent, of course, there is no risk transformation in principle, that should also be relevant when you discover financial stability implications of market developments, and in particular higher market quotas for big techs. So I would appreciate very much if you could actually tell us something about how you see actually the role as a deposit taker, how important this thing is in terms of explaining the evolution of the competitive position of banks vis-a-vis non-banks, and in terms of the financial stability analysis. And my second question, a very quick one. You mentioned that you are concerned, I think you're rightly so, that the emergence of big techs and the competition that big techs actually generate in terms of in the market for lending, that could actually sort of generate some adverse distributional effects in terms of the quality of the borrowers. So banks would take the worst borrowers, and big techs actually will be able actually to grab the good ones. But this is apparently this is not what is actually happening in practice, right? If you take the example of China and what Ant Group is actually doing, would you see that they are pretty much focusing on giving loans to previously unbanked households in particular, right? So they are basically working and specializing on the extensive margin rather than the intensive margin. So they are basically providing credit to borrowers that were excluded to the banking market in the past. So how would you actually assess that a small piece of evidence, how this will actually fit into your analysis? Thanks.
Well, thank you, Fernando. Let's Jorge, let's collect a couple of questions as we get to the end of the session. Let's go to Bert. Bert has a question on privacy.
Thank you. My question, let me be very short, relates to one issue that Jorge spoke about. So data, right? So I totally share your evaluation that data is really important. And something like an essential facility here, and I would like to come back to your ideas on data sharing, and I must admit I have some problems seeing how this could ever work in practice, right? For questions like who do we make data available to at all? Would that only be to the bank competitors of a big tech, only to the big ones, or to all ones? And in which market would those companies have to be active to receive access to that data? Which data are we speaking about anyway? Because big techs may be active in many different markets, ranging from search engines to social networks, and that's all kind of different data. So do we need to have a look in the value chain of banking to find out which data we would be interested in? It's really complex. And then consent, which you mentioned. So you mentioned this data externalities. That's a great concept. So that's really something really to think about. But consent may be selective, right? So what if I, as an individual, would say, well, I'm happy to share my data, but only with that and that bank and not with another one? Is that something that we would be willing to accept? And what if people would share, well, I can share my data, but I want to receive money for it? Right. So the core legal question of who owns this data in any way. So a lot of really difficult questions. And I was wondering whether you have any ideas on, is there any reasonable way to solve this, right? And to actually give access to competitors to this data, which I totally agree upon is very, very important. Thank you.
Great, thanks, Bert. I think, Karen, this question is also very relevant for your presentation as well, and on the broad issue of data governance. Just conscious of the time, maybe we can squeeze in Leonardo for one last comment. Leonardo?
Thanks, Yoon, thanks for this very relevant question. I think that the optimality of sharing data is extremely important, and indeed it is at the center stage also of regulatory actions in China, trying to decide what is the optimal way the data could be shared between the big tech and the financial institution. And this will be crucial because I really think that there are two open questions here. First is the technical design. Is it optimal to share the data? And because financial institutions, they have problems in terms of then organizing this data in terms of silos. And there is also the question regarding optimality in terms of how to not to destroy solutions that are based on cross subsidies between the various borrowers. So this is a crucial question, and I think that we need to answer with both theoretical and empirical models.
Excellent. Karen, Jorge, the last words are yours. So Karen, would you like to go first?
Thanks, Jan, and thanks for these excellent questions. I think on the there are a couple of questions here that relate to the data sharing and some of the challenges there about figuring out, what would really even be optimal and what the implications would be. I think this is a really important nested sort of set of open questions here, and I agree with you completely, Leonardo, that more theoretical and empirical work are going to be needed on these topics. Just to illustrate, the full width of this, I guess, I think on the demand side as well, the consumer side, really understanding how consumers value data and perceive data, their trust in data sharing. Some of this could be very context specific. There's a little bit of a small nascent part of the literature that has started to get into this, looking at this with in some experiments, in some empirical settings, and it's quite nuanced. Some of the insights there is my take on that part of the literature. So that's just on the demand side, and then there are various questions, about how you do this in a way that really achieves those top line public policy goals of protecting consumers, promoting effective competition, and making sure the data protection is where it needs to be, making sure that we can meet other aims like financial stability, where with that and competition, but then it may need to be access to data in ways that have to be worked through because of some of the potential considerations for consumers and protection. So I think I'll leave it there. I think, fascinating, important, open questions on that.
Excellent. Jorge.
Okay, thanks very much again for the questions. I agree with Karen. They were very well pointed and all very relevant. I'll touch very briefly on the issues raised by Fernando. So on deposits, I think that my first reaction to why is it that big tech platforms don't want to be deposit taking institutions is that actually there is nothing that makes it impossible for them to do so. They could take a license. Is that they don't want to, And so I think that is, using a reveal preference argument, it must be that the advantages that that having those deposits confer do not compensate or offset the regulatory burden that will be, brought along with that decision. Now, definitely being able to operate with in the deposit and on the credit side of the banking business generates some complementarities that are positive. I mean, to some extent, you could argue that some of the soft information that banks have about their clients and potential borrowers stems from the fact that they deal with them on the deposit side of the business. But again, that's one form of soft information, and there are other forms of soft information that are in the hands of the big tech platforms that may be more than enough for them to be able to compete in those areas where they are really interested, which are the areas with the high returns on capital employed. So, I think that, banks in Europe are much more likely, or in the US, much more likely to put up a fight with the big techs than in China, precisely because I think that the extent of the bank population is greater. The relationships that banks in Europe and the US have with their clients are much stronger, and so on and so forth. And they possess, therefore, a stock of soft information and soft capital that will protect them from the big techs in a way that perhaps has not been the case elsewhere. And that leads me to the China situation. I think that in China, the reason why we see, in my opinion, the big techs more on the extensive margin than in the intensive margin is because you have a different degree of penetration of traditional banks, and you have much less financial inclusion. I don't know how that would translate into Europe. And as I said, at this point, my concern is that I'm not even sure how the big tech plans are going to unfold with respect to these issues. I mean, whether they are going to continue in the direction that they seem to go, which was more of confrontational with traditional banks, or they are going to accommodate, which perhaps worries me even more. And just to conclude, data is an essential facility. Sharing data is very complicated. I think that to some extent already a number of authorities have contemplated how to do it in the context of open banking and the PSD2 directive, where consent plays a role, where there are complex solutions. And I know that the story is not an unqualified success at the moment, so which means that it's a difficult thing. We need to keep thinking about it, and I agree with Leonardo. I think that we need to keep investigating the issue to see whether that, if that is the solution, how to implement it so that it proves effective.
Excellent. Thank you, Jorge. Thank you, Karen, for setting us up so well for the policy panel, which is going to follow right afterward. We'll just go offline for 1 minute to change the setup, but we'll come back as I think in 1 minute probably. So so stay online. See you soon.
Thank you. Thank you, Karen.
Thank you.
Thank you, Hyun.
Thank you, Jorge. Hyun.
Good afternoon and welcome to this policy panel on competition issues around big tech in finance. The opening session of the conference and the first session have set the bar very high in terms of the depth and quality of the discussion, and very much expect our discussion to be to meet this standard. But it's being made much easier because the topic is so obviously an important one. Competition issues around big tech in finance. It's very clear already from the discussions today that competition is a red thread going through the whole discussion on big techs in finance. We've heard about market power already. We've heard about, we've even seen a Harberger triangle evidencing the market power. We've heard about the kind of complementarities created by access to data and the kind of really positive feedback loops created by new services and access to data. And at the end, the question, of course, is is there anything we should do about it? Is it good or bad for competition? And what should competition authorities and other authorities do about it? So for that, we have an outstanding lineup of speakers. So we'll start with Elsie Ado-Awadzi, Deputy Governor of the Central Bank of Ghana. We'll then move on to Douglas Arner, Professor in Law at the University of Hong Kong, then to Catherine Batchelor, who's the Director of the Digital Market Unit at the Competition and Market Authority in London, and Christina Cafara, who's a Senior Consultant with Charles River, and finally Tobias Drian, who's the Financial Counselor and Director of the Monetary and Capital Market Department at the IMF. So we have a depth of knowledge about both analytics, policy issues, and the real world, which is exactly what we need to answer this difficult question. So without due delay, let me give the floor to Elsie, and particularly the question I would like to ask you, Elsie, is about your experience in Ghana with payments and mobile money, and how much have you been able to tame payment monopolies in Ghana, and what lessons can you draw for the other countries? So, Elsie, please, the floor is yours.
Thank you, Benoit, and hello to all my co-panelists. So Ghana has had experience with mobile money going back maybe 12 years ago. This was in the after the mid-2000s. I must say that it started a bit slowly. This was on the back of East Africa having pioneered it. And but we have leapfrogged over the years in quite remarkable ways. As we speak, there are about 19 million active mobile money users for a population of 30 million. And then you see the growth, the rapid growth in this area. For example, we're told that Ghana is the fastest growing mobile money market in Africa. Also that around the world, Ghana is the country that has the third largest mobile money payment rate, next to Kenya and China. And then reports say that 82% of our GDP is held in mobile money wallets. So you see the sheer significance of the market. And more importantly, it provided more convenience in payments. It helped informal sector businesses become a little bit more formalized, because now they're able to receive payments and therefore they're able to sell more of their services and their products. And then also we're seeing that it has really accelerated financial inclusion, because now every Ghanaian in every corner of the country that has an access to a mobile phone is able to operate a savings account, obtain loans on the back of mobile money, receive remittances from abroad, and really do a whole lot more, including invest in pensions, products, insurance policies, and the like. So it's really been a phenomenal success case. It keeps growing. And there are many other innovations that are happening on the back of this. In terms of lessons, I would focus on three main ones. The first one is that infrastructure is important, and the type of infrastructure and the governance around that is something that countries need to think clearly about. So in addition to the mobile money operators, really the telcos that had to make vast investments in infrastructure, the central bank also decided in the mid-2000s to invest in the national switching platform that allowed all the telcos to connect to it. And therefore, regardless of which telco network you used, you were going to be able to switch money around because of the investments in infrastructure we had made. And we did this through a wholly owned subsidiary that we set up. So infrastructure is key. And over the years, this infrastructure has evolved to a point where we have a fully interoperable switching system. So regardless of which telco network you're on, regardless of which bank or which other credit institution you have an account with, you're able to move money across. And that's been really phenomenal. That has also helped the smaller fintechs to be able to innovate right in on the back of this infrastructure. The second key lesson is the policy and regulatory regime. And we have worked on this over the years, over the last 12 years. We started largely with an activity-based regulatory approach. So banks and other financial institutions were allowed to partner with mobile money or telcos to be able to deliver mobile money. The important thing for us was that these transactions were backed by cash that were held in trust accounts with banks, so we could follow the money. Now, it was largely activity regulated because we cared about consumer protection rules, we cared about AML, CFT type regulation, we cared about product, regulation, making sure that these products were well designed and acceptable to the market and all of that. Over the years, we have transitioned also into an entity-based approach in terms of regulation. So in 2015, we issued regulations that required the telcos to ring-fence their mobile money operations into fully owned subsidiaries, right? So that we could have direct regulatory and supervisory oversight over those entities. Because telcos come under a different regulator, and we wanted to make sure that all their mobile money operations were ring-fenced into subsidiaries. So we have since then obtained regulatory oversight over these entities, and we set out rules in terms of capital, in terms of operational resilience and governance, more recently cybersecurity rules and all of that. It gives us a lot more space to be able to regulate them. So that's what we've done. We have opened up the space so that more and more entrants, mostly on the fintech side, are coming in as payment service providers and partnering with these dedicated mobile money operators and banks, and developing a full range of activities, of services and products that help to advance our financial inclusion objective. The third and last lesson I want to highlight is the consumer protection aspects of this, and we have also taken that quite seriously, particularly the pricing, because what we found was that there was a period of time where consumers were not as excited about this as we wanted them to, and much of it had to do with the opacity in pricing and all of the hidden costs that they had to confront. And so we've been very strict with the pricing regime and promoting more transparency in pricing, and having conversations with these operators to say, how are you pricing? What are the components of your pricing? Can you make these a little bit more transparent to the market? And we believe that all in all, these have contributed to the growth of the phenomenon of mobile money banking in Ghana. And I think that the prospects are huge. Now, dovetailing into QR codes, on the back of mobile money, we have developed a universal QR code which I believe is helping really to also tame, the dominance of the big telcos that have been in the mobile money space. Because now with the what we call the Ghana QR code, which is again is promoted by a wholly owned subsidiary, the GIPS, which I mentioned, that owns the national switch and the interoperable framework. The QR code is rolled out across all telco networks, all financial institutions. So it makes it easy for banks to go to any merchants to say, I can offer you the service and I can acquire you, the startup costs are very low, so most merchants can afford this. It's actually next to nothing because it's also done by the central bank subsidiary. And then it doesn't matter who's paying. Once they're able to scan the QR code or are able to provide the USSD code, they're able to make payments regardless of where their money sits. Whether it's in a bank, whether it's in a savings and loans account, whether it sits on a mobile money wallet with any of the telcos. So this has really helped, and it's a real game changer in terms of how the market is having to function. And it's much lower pricing for the merchants. And so we're finding more and more merchants choosing that over mobile money. And so that's providing some competition in that space. Thank you.
Thank you very much, Elsie. So infrastructures, regulation, consumer protection, that helps a lot to put the right structure on our discussion, and then I'm sure we'll come back to it in the discussion. So let's move from Ghana to China and turn to Doug Arner. So Doug, you've been a keen observer of the fintech and the big tech scene in China, and to use the words used by Agustin Carstens in his opening speech, the big tech activities in China have moved very fast from too small to care to too big to ignore, and maybe too big to fail. So how can authorities react in real time, and how should they react? So Doug, the floor is yours.
For that, Benoit, and great to have Agustin sort of bring up that remark, which I think we've been amazed how well has described much of what we've seen. I think China, as you suggest, is an incredibly interesting case because China has probably experienced the most rapid and comprehensive digital financial transformation of any country in history. And I think it provides a very interesting case study, in particular, because if you look at China's evolution of digital finance over the past decade, you can think of it initially as an experiment in some ways to try to address existing constraints in the traditional financial system. Existing constraints we're familiar with from every economy, and the idea was very much that the traditional financial system was not very effective at directing financial resources, in particular to small and medium-sized enterprises and the non-state sector. And so there was essentially an experiment in allowing digital finance to evolve as an effort to try to address this grand challenge. And on one side, you can see the evolution of thousands of P2P platforms, which largely failed as a way to address this problem. And the other, you can see the evolution eventually of large digital platforms. In other words, the platformization of finance. And if we think about the evolutionary trajectory of Alibaba, of Ant, or of Tencent, essentially both began with payments and seeking to integrate payments with other forms of activities, e-commerce in the case of Alibaba, gaming and social media in the context of Tencent, and reflecting the idea of network effects combined with economies of scope and scale. So we can see network effects in tech and data, economies of scope and scale in finance. The combination of the two, we eventually see the emergence of a small number of very dominant players, particularly in the context of payments. Ant and Tencent eventually with 1 billion payments customers each. And using the data pools built from those payments platforms as well as a range of other activities to essentially do something which we had always wanted to achieve, which was real-time automated cash flow and reputational analysis for SME lending. And generally agreed, success in the context of that platform-based model in increasing financial resources available to SMEs. And then taking that data-based model and expanding into investment, money market mutual funds is the paradigmatic example with Ant, and of course, as I just mentioned, lending. But I think the question, and often if we look at Chinese strategies, it's an objective of trying to balance stability objectives, both financial stability as well as social stability, with growth, development, and innovation objectives. And what I think we can see is that it was clear by 2019 that Ant in particular was emerging as a new systemically important financial institution, one of the major players. And so efforts to, one, build alternative approaches, and two, build a regulatory framework. And I think the idea here is if we think of tech and finance, we can think of this current era, which we categorize as FinTech 4.0, as a period of platformization. And what platformization allows is the very rapid movement from new entrant to large scale to potentially too big to fail, and the necessity of balancing both the benefits that we can get out of data aggregation with the concentration and dominance risks. And I think in the context of China, the eventual conclusion was both concern about the stability risks as well as impact that concentration and dominance were having from the standpoint of restricting innovation and development. Thanks.
Thank you very much, Doug. May I ask you a follow-up question, just to follow up on what you just said? Data can be addressed under the angle of competition, namely aggregation and concentration, as you just did. But how much does privacy weigh into the considerations of the authorities in China?
Yes, I think this is a very important point. And, you know, if we think about finance, of course, today is one of the world's most globalized, one of the world's most regulated, and one of the world's most digitized industries. And so that means when we're dealing with finance, essentially, increasingly, we're dealing with data. And what that means is that, yes, as you highlight, we're seeing, if anything, an increasing policy consensus amongst countries that data use is a core strategy for competition and development, competitiveness and development going forward. And if we look at different economies, we're seeing different strategies as well as different cultural or policy approaches, not only to the question of how you achieve aggregation, and very happy to talk about this, versus balancing who actually owns and controls data, and that's that idea of privacy protection or individual rights to own or control data.
Thank you very much, Doug. So now let's ask a competition authority. Catherine, the Digital Markets Unit has just closed a consultation on a new pro-competition regime for digital markets. Can you tell us about the proposals, about the reactions, and what would the implementation look like in practice?
Yes, of course, and thank you for inviting me to speak today and participate in this panel. So it's not actually the DMU that's closed the consultation, it's our government, and they've just consulted on proposals for a new competition regime for digital markets. And this consultation follows a range of reports that have been published across the world, but in the UK most notably the Furman Review, which have all concluded that a new approach is needed to dealing with the competition problems posed by the most powerful platforms. So these reports have noted the harms that can arise as a result of concentration and market power held by these big platforms. So the risks directly to consumers in terms of what we always say, higher prices, but obviously we've talked about privacy, so loss of data and lower quality privacy standards, but also the sort of indirect harms that can result through the sort of businesses that rely on the platforms to trade or to advertise, but also the competing businesses and the harms that the big tech companies can pose to competitors, and through that the sort of long-term risk to innovation, which Douglas alluded to. And so given these harms, these reports have concluded that a new approach is needed, and that relying on ex post antitrust enforcement to deal with the sort of anti-competitive conduct on a case-by-case basis, you know, always sort of looking narrowly and acting after the fact, is not sufficient, and that rather a sort of ex-ante approach is needed to set the rules of the game in advance, and to sort of shape these markets in a way that delivers more vibrant competition and innovation in the interests of consumers. And that's what these proposals are aiming at. And there are sort of three key parts to the regime. The regime would apply to firms with strategic market status, and that is intended to mean firms with substantial entrenched market power, and where the effects of that market power are particularly widespread or significant. So I should say the regime is aimed at a very narrow group of the most powerful digital firms. And for firms that meet that test, there are three key pillars. The first is this code of conduct, which is an enforceable code and is intended to set out requirements on these firms in advance. And this is very much to address the concerns around these firms taking advantage of their powerful position, either through exploiting consumers or businesses, or acting to exclude or quash their competitors. So the first pillar is the code of conduct. The second are what we term pro-competitive interventions, and these are interventions like data access or consumer choice remedies, in the most extreme cases, separation remedies, which could be implemented in order to address the root causes of the firm's market power, or the reason why they have such a powerful position. And these are very much intended to promote competition, to create greater contestability and opportunities in the market for greater competition to emerge. And the third pillar of the regime is a bespoke merger regime for those firms that have this strategic market status. And that's intended to enable the CMA to greater scrutinise transactions that these firms enter into. In terms of implementation, so that is a consultation, and as you say, it's just closed. And our government has committed to moving forward with the legislation that's necessary to enact these proposals as soon as parliamentary time allows, and I can't tell you any more than that. But in the meantime, whilst we're waiting for that legislation, the DMU has been established within the CMA in shadow form, and we are working on preparing for this new regime. So thinking about the problems that it might need to address and getting ready to address them, but also continuing to use the CMA's existing powers to the full extent. And you'll have seen there's a range of markets and antitrust and consumer cases that we're taking on across digital markets. So a brief summary from me.
Thank you very much, Catherine. I'm sure we'll have the opportunity to come back to the consultation, but I would like to move to Christina Cafaro. As a consultant and as a lawyer and also as an economist, you have a 360-degree view of different approaches to big techs in finance and to different regulatory proposals, and you've been critical of the new EU regulatory proposals. I quote, effective merger moratoria, breakups of past anti-competitive mergers, wall-to-wall interoperability, data protection, and new thinking around shared digital infrastructures to create scale and favor new opportunities. And that's all needed in Europe. So can you elaborate a little bit on this and compare the European approach with other approaches, and why would these steps that you've been highlighting be needed?
Thank you so much, Benoit, and thank you for this invitation. It's a pleasure to be here. Let me start with what I consider an important starting point for anyone in the private sector who isn't speaking from the public sector. I'm a consultant, as you say, so in my career I have worked consistently. I've worked for Google, worked against Facebook, I've done some work for Amazon, I've done some work for Apple, for News Corp, for Uber, and for others. Let me start with tracing the excerpt from my recent paper a little bit into context. I come at this as someone who spends a lot of time thinking and working on digital regulation, on antitrust cases in the digital space. And it's fascinating for me to see this event and indeed the number of papers that are emerging in this world, in the world of financial conduct, in the world of financial stability, essentially taking notice of the great amount of activity that is taking place in the regulatory and antitrust space around the power of digital power. So it is a fascinating development to see that the financial world is taking this on board. And what we're faced with now, broadly, at the European level, but not only, it's true in the United States and also elsewhere, is a huge amount of experimentation that is going on how we should go about regulating big tech across the world. Why are we witnessing this big pivot towards regulation? Because quite plainly, antitrust has failed in regulating these companies. I mean, Catherine put it very mildly. She said there are difficulties. The reality is antitrust has failed. We are facing a market power crisis and a privacy crisis, and the two compound each other. And the reality is that antitrust has not been capable of preventing the erection and the entrenchment of this market power for all of the kind of reasons that Jason Furman went on this morning. They have a particular set of characteristics that mean that it is quite difficult to stop that progression in so many ways. They have inherent advantages, which have got to do with data and network effects. But fundamentally, we have failed to do it. In the US, there's been a permafrost in terms of antitrust for 20 years after the Microsoft case. In Europe, notwithstanding the great good intention of the European antitrust regulators, we've had a set of cases against Google in Europe that failed miserably. Google has continued its progression. The only country that has enforced against Facebook has been Germany and no one else. Things are beginning to bubble up, but not much. So against this sense that antitrust is effectively a total failure in this space, notwithstanding the good intention, we have collectively felt that we need to complement this idea of antitrust, which is exposed, which is narrow, looks at case by case, with ex-ante regulation. And the ambition is to create a regime which is clear, which is self-enforcing, which is actually, in some sense, sufficient for companies to look at and just, to some extent, self-regulate. My skepticism of the European proposals, and let me say, I believe in the need for regulation, and I'm a great fan of the UK model, which is a bespoke one, and the intention is to really look at individual platforms one by one and effectively focus on them and their particular problem. The problem with the one that the European Commission has come up with is that it is effectively a version of the antitrust cases, only in the form of a synopsis. So you take all the cases that have been done against Google, against Amazon, and not completed, incidentally, Apple and so on. You kind of condense that into a synopsis, and then you have Article 5.b. You shall not set preference. What does that really mean in practice, and how does that actually get implementable? My prediction is that this is going to have some effect in policing the worst effects, the worst manifestations of abuses of dominance on a particular platform. But to use the language that Jason Foreman was using this morning, this is not going to implement competition for the market. These companies, the 5, the 4, will remain hyper-dominant in their spaces for the next 20 years, unless something more even than this regulation takes place. And this is the context in which I think we need to look at mergers very seriously. Market power has been entrenched by incredibly poor enforcement in merge control. We need to look at it, what I call it wall-to-wall interoperability. There's huge resistance to that, but it is absolutely important to allow network effects to be overcome. And we also need to look at, ultimately, at this idea of shared digital infrastructure, which is an idea that a lot of people are thinking about, because what we need to create is that there are missing layers in the internet that have been filled by proprietary walled gardens. We had Internet 1, and now we have Web 2, which is effectively proprietary, and where all the economies of scale and scope are effectively realized at the firm level. So we need to create a different way of thinking about Internet 3, Web 3, giving the opportunity to create digital identities that are shared, protocols that are non-proprietary, so that eventually we create the opportunity for more digital diversity. That's the sense in which I think that the current rules don't go far enough. Thank you.
Thank you very much, Christina. This was very clear words and also strong words. You talked about the market power crisis and a privacy crisis. If I may ask you a follow-up question before moving on, I mean, how much does the provision of financial services add to this market power crisis and this privacy crisis? Because presumably they were there before these companies stepped into finance. So how is that going to change the landscape?
Well, I mean, financial companies, banks, I think we heard a good presentation from Portway that describes the need for injecting competition also in these more traditional, conventional markets. So the good side of that entry into these markets is that incumbency of that traditional kind can be challenged. But I mean, we're all concerned with the data aspect of things and the advantage that that creates. When I talk about a privacy crisis, this is the fundamental issue of our time. And the failure of antitrust that I mentioned about a moment ago is also a failure of integrating the perspective of privacy. We have pursued antitrust and privacy as two silos. And the antitrust people have been saying, nothing to do with me. I'm looking away. I'm doing market power. I don't care for privacy. You've got the data protection people over there. You've got the GDPR. In reality, the data protection got plastic knives to fight the big giants because they don't have the means. GDPR is not enforced. Nothing is happening. So this is a big problem. So financial operators are coming into this, and the big question is how will that all intersect and interact? But the big discussion now at the level of market power and privacy data protection is huge, and we need to solve that as well as integrate the perspective of financial markets and financial institutions.
Thank you, Christina. So last but not least, we move to Tobias Adrian from the IMF. So Tobias, the IMF has been very active thinking about fintech and big tech and data. Even this morning, there was a staff discussion note out on a global approach to data in the digital age. So can you share with us some of your perspective from the fund's perspective?
Yeah, thanks so much, Benoit. Thanks for having me in this fascinating panel. The discussion here was already very rich, and let me start off right where Christina left off. So in 2020, the Bank of England did a survey which estimated that over 70% of banks and over 80% of insurers use just 2 cloud service providers. And when you look globally, about 50% of cloud services come from just 2 providers, right? So, the points that Christina and Catherine and Douglas made about concentration and the potential for market power is very, very clear. And financial services are using those services extremely actively. And of course, as a financial regulator, that immediately rings a bell in terms of systemically important activities, right? When your financial system depends on infrastructure like services, that have this massive concentration, that is certainly worrisome. I think Douglas already said, the problem, right? I mean, what would happen if the cloud services were to fail, if one of those companies were to fail? Devastating impacts on financial services, and that in and of itself is a huge challenge. So, secondly, now there are potential benefits as well from big tech entering into services, and that
so
more financial inclusion.
It seems that we're having a small technical issue with Tobias, so we'll try to reconnect him.
So the analyst, the cross-subsidization very much.
Okay, so we do have an issue with Tobias. That's the beauty of online conferences. So while we are trying to fix it,
Can you hear me now?
let me come back to the other speakers, let me ask the speakers if is there anything you would like to react to in what you've heard so far before I open the floor, and of course we'll give a chance to Tobias to come back and complete his remarks. But is there anything you would like to add or to react to?
No? Okay. I could,
yes, please.
Benoit?
Yes, please.
I just wanted to sort of add my voice to the concentration risk matter. And I think for many of us, what happened on Monday with the Facebook network crashing for perhaps half the business day, about 6 hours or so, was actually quite revealing. I mean, not that we hadn't thought of that possibility, but seeing that happening, then the 3.5 billion people around the world that have become so used to these platforms, right, and the sheer concentration of risks that entails. For a regulator like us in Ghana, we allow the banks to use what they call social media banking, tools, and therefore a lot of the new sort of clients are sort of onboarded through Facebook or WhatsApp and Instagram and all of that, basically to create more access to finance. And that was quite frightening. And it's actually about time that we did something about those risks, quite apart from the cloud-based banking issues that Tobias was alluding to. The fact that we become so dependent on these and the sheer operational risks that we're all having to deal with. And then thinking of the fact that in some markets, these big techs are also playing directly as financial service providers, in a very subtle way, but really they're competing with banks and other licensed financial institutions and providing services that are not just tech related, but also are financial services without much of the regulation that financial institutions must deal with. And there's this big black hole in the global architecture and regulatory framework where no one is really dealing with this issue. So countries that are dealing with this as competition or as a data protection or, or ancillary approaches, but no one is really looking at the financial stability risks and the fact that this has become a globally significantly important issue, but then they're free in terms of all of the rules that relate to other players who are seen to pose such risks to the global financial system. So I think it's a wake-up call, and it's important that this conversation is happening at this time. Thank you.
Thank you, Elsie. I mean, that's a very important point you're making. That speaks to the role of big techs, not only as providers of financial services, but also as critical service providers in the financial field. I've been a standard setter for financial market infrastructures, and the elephant in the room was the role of big tech companies in providing cloud services, for instance, which are critical and which can create nodes of contagion outside of the financial system, but nevertheless important. So may I kind of turn to Catherine and ask, I mean, how do you deal with that in your framework? How do you deal with the role of, say, the Facebooks of this world as providers of services that are part of the infrastructure that the financial system needs to work?
So it's, as you said, really, really topical, and we've spent a fair amount of time talking and thinking about this week for obvious reasons. I think there's 2 points I would make. Firstly, that if you want greater resilience, then you won't necessarily use competition as the tool to address that, but nevertheless there are important interactions. So the regime that we're building, its primary function will never be to support greater resilience. That's not what's been outlined for it. But nevertheless, there are important interactions between the competition regime and questions around resilience. And I think, I saw the comment Vestager had made around, does competition, one of the lessons of this outage being, well, you need greater competition. And I think I've landed on sort of 2 points. The first being that competition will not necessarily deliver you less outages. If you think about the sort of traditional relationship between competition and resilience as a policy objective, quite often, the impact of really vibrant competition can be a race to the bottom and actually more of these kind of outages. But actually what is really important that competition gives you is it can lessen the impact of these outages. If you have greater choice and consumers have greater alternatives, then actually if something does go down, then the impact of that is lessened. So I think it's important to understand that kind of dynamic. Competition won't necessarily put the incentives in place to drive the right incentives in terms of resilience and outages, but it can be really important in managing the impact of those outages. In terms of the framework we're putting forward, as I say, resilience will never be the sort of primary motivator of the DMU. But as I say, there are really important interactions, as there are with privacy, as you've recognised, as there are with financial services. And one of the sort of key questions that our government is grappling with is the extent to which we as a regulator should be predominantly focused on competition, or the extent to which we should have discretion to be able to factor into our decision making the impact our decisions might have on these wider policy objectives like resilience. And obviously we're very in favour of this idea of, when we're thinking about the impact and intervention to promote competition is likely to have, being able to consider the sort of holistic impact of that intervention, not only on consumers, but also on privacy and on resilience and on these wider objectives. But there are sort of legitimate questions around the extent to which we should be able to take those kind of factors into account in our decision making. So as I say, it's a bit of an open question, and it's something that our government are grappling with, but it's something we're thinking hard about. It's not easy.
Benoit, can I jump in and make a brief comment to this?
Yes,
if I may.
And please be brief, because then we need to give a chance to Tobias to say.
Yes, I'll be less than a minute. So I think, of course, the outage is a very graphic example of what I was talking about. No one in their right mind is deluded that competition into tension can bring about more resilience. Okay, this is delusional. It shouldn't even be talked about. The question is whether regulation of some sort can bring about tension. To the extent that regulation is ersatz competition policy, forget it. It's not going to do it. It's going to just tinker at the margin with, okay, don't be beastly to the sellers on Amazon. Okay, that's what it's going to do. Don't be beastly to the developers on Apple. That's what it's going to do. But it's not going to bring about resilience. For that, you need more. We need people who think about new generation internet. We need people who think about the missing layers of the internet, communication, payments, data sharing. All of that is now proprietary, is a walled garden and needs to be taken in a way that is shared, common, public. Is that short enough?
Yes, thank you very much. Well, I guess it's part of the traditional dilemmas that regulators have to face, that they're asked by society to meet different objectives. And in our conversation, we had competition and financial stability already, and that already creates trade-offs. And now we have privacy, and now we've been adding resilience as an additional objective. So obviously, there are choices to be made. But let me give the floor back to Tobias, who could join us back so that you can just share what you had to say. So I guess we don't have the image, but we should be able to have a sound connection.
Oh.
No? Okay. So I guess we were right to bring resilience into the discussion. Yes.
So I'm not sure what happens. I'm using a call in here.
We can hear you, Tobias. So
you're able to hear me now. Okay, wonderful. So I was going to make a point about bundling and unbundling. So part of what we are seeing in the fintech domain is that startups are entering financial services, and they're very specialized, very low cost, and that increases competition. So that's a good thing. But of course, on the other hand, big techs are buying up a lot of these startups, and they're bundling them back together in a kind of, in something that could become a walled garden ecosystem. And so in some sense, they're going against the unbundling, against the increase in competition through new entrants. Of course, that can bring synergies in terms of financial inclusion, lower costs, through the usage of artificial intelligence, cross-subsidization, and economies of scale. But on the other hand, it can also create market power. And so this is where I think earlier speakers already alluded to the need to take another look at regulations. And it's really a kind of coalition of regulators that have to look at this, right? It's financial regulators that have to come together with competition regulators. And then data is the third, right? So there's a financial stability aspect, there's a competition aspect, and there's a data aspect. And having an approach that is capturing all of these three aspects is very much first order. Let me stop here.
Thank you very much, Tobias. And I'm glad that you're bringing this question, which I wanted to ask the group here. I actually asked it to Jason Furman in the first session, and the answer was, why don't you raise it in your panel, which I'm doing now. And that's about cooperation between different authorities. I mean, what's the scope for cooperation between competition authorities, financial regulators, data protection agencies? Is it working? Is it not working? And what can we do about that? So if any of you wants to
I can obviously offer a perspective. Sorry, Douglas, did you want to go first?
No, please be my guest, Catherine.
I was just going to say, given it's about cooperation, I should probably say a bit about what we're doing in the UK, given I'm at the competition regulator. We have this thing in the UK called the Digital Regulation Cooperation Forum, which is us, the CMA, the ICO, which is our Data Protection Authority, the Financial Conduct Authority, which is our financial services regulator, and Ofcom, which is our communications regulator. And we work very closely together on matters of mutual interest in relation to digital markets. And, it's certainly been a journey. It was established last year, but we've always worked together in some guys, and we published a work plan in March on the areas that we're working together, and it encompasses a whole range of different areas. So it includes what we call strategic projects, so things like algorithms and big tech use of algorithms, which is something we are all grappling with. We're all trying to get to grips with. Why not do it together and pool resources rather than duplicate and all look at the same thing? It looks at things like the interaction between policy objectives. So I was talking earlier about the interaction between competition and resilience, but we're also looking at the interaction between competition and privacy, and we published a joint statement on that earlier in the year, but also things like the interaction between competition and online harms and content, given that's very topical in the UK at the moment as well. And lastly, it looks at things like skills and capabilities. We're all building new functions to address these challenges. We need people, we need skilled people. How can we work together to bring those people in? So I wouldn't by any means say it's perfect. It could certainly be improved, and we're working hard on it. But I think the forum itself has certainly, from our perspective, been a very welcome and productive initiative. And I hope it's the start of much closer working across a range of matters. But very interested to learn in the approaches other people have, but also any thoughts others have on what we could be doing better.
Thank you. Any other thought on this question?
Yeah, if I may add to this.
Okay. Elsie, let's start with Elsie and then Tobias, and then we'll come to a close.
Okay, excellent. So I believe firmly in the idea of cooperation among regulators. I like what Tobias referred to as the coalition. I think it's necessary because, as Christina said, there are often what may appear to be competing policy objectives. I don't think they're competing at all, but without this cooperation mechanism well laid out and working well, every regulator is going to see things from their silos, and in the end, we don't get the overall benefits of regulation. And so however this is done, I think the important thing is that it's done. I like the idea of what the UK does. In Ghana, we have a payment systems and services advisory council that is made up of the central bank, is made up of the communications ministry that regulates the telcos. It's made up of even the Ministry of Finance is there, some industry groupings as well, like the Bankers Association, the FinTechs Trade Association, and all of that. So it's really like a stakeholder grouping that sort of comes together to think through the resilience of the payment system, as well as the financial stability issues in a comprehensive way. And then we have a Financial Stability Council that is made up of all the financial sector regulators, including the central bank and the Ministry of Finance. We don't have the telcos regulator there, for example. We don't have the trade associations there, but at least across the financial system, we're able to have conversations amongst each other as regulators in terms of risks to financial stability. And so, issues relating to operational risk, and basically, the interaction between finance and technology and all of what is going on in that field come to the fore. And each of the regulators then finds the tools they have within their toolkits to be able to address emerging risks. So these are a start, and I think ideally the idea would be to work a little bit more closer with other regulators like the Data Protection Commission and others to really find solutions to the problems that we face as an emerging market, with a lot of fintech and tech activity, with real benefits for us. So basically how we work towards mitigating the risks that are attendant to all of the benefits that we're seeing in our market. Thank you.
Thank you, Elsie, and Tobias, you will have the last word.
Yeah, just complementing this very rich discussion, is this question about entity versus activities-based regulation. And my sense is that the two have to work together. In many countries, it really wouldn't be possible. In many countries, it wouldn't be possible to have entity-based regulation. This is something that the home country of the big tech would have to put into place. And of course, that's only in place in a very small number of countries at the moment, that you have a sort of like consolidated regulatory approach for big tech firms. So for the time being, in most countries, activities-based regulation is the only approach. So for example, there could be regulation on data, or regulation on bundling, regulation on competition. But ultimately, that would have to be complemented also by a more entity-based approach, at least in the home country.
Thank you very much, Tobias. Unfortunately, we have to move on to the next session. I would like to thank all speakers very much. This has provided a lot of experiences and very thoughtful remarks that we can build on for the next sessions. Talking of the next session, it will be about the experience in India with big tech, fintech, and banks in payments. You don't have to reconnect, so we'll make a short pause, and please stay tuned. Thank you very much.
Thank you, Benoit.
Good afternoon, everyone, or good morning, good evening, wherever you are in the globe. So welcome to this last session of the first day of this conference. I think it has been already quite an intensive day. We have heard a number of interesting remarks by different prominent speakers. I think it's clear to everyone by now that this issue of big techs actually get into a complex set of opportunities and risks. Of course, risks should be in principle the main focus of regulators. And this type of risk basically comes, as has been discussed at length, from the potential for big techs to leverage technology and particularly data superiority to build dominant positions in different market segments, and in particular the market for payment services. And that concentration, of course, could have serious consequences, not only in relation to market contestability, but also, as has been discussed, particularly in the previous panel, also in areas like adequate market functioning or eventually also financial stability. So those risks certainly justify actions taken in different jurisdictions around the globe to introduce some specific regulation, what we call sometimes entity-based regulations, that with the aim of addressing the specific risks that big techs actually generate, particularly for the financial system. But of course, regulation may not be the only game in town. There could be other policy actions that could actually be implemented in order to address the risks posed by big techs. And indeed, there could be a case for governments to offer public goods, to put in place public infrastructures that could well constrain the ability by, sort of large players, in particular big techs, to appropriate for themselves all the benefits of the economies of scale or for the network externalities that their activities could actually generate. And this is the approach which has been already followed in several jurisdictions. We just heard the example of Ghana in the previous panel, but it's certainly as well the case of India. In this country, authorities launched in 2016 a unified payment interface, or UPI, run by the National Payments Corporation of India, NPCI, which constitutes an open and efficient platform in which both commercial banks and technological companies, big techs, fintechs, participate and offer their services. UPI is a success story. I mean, we are talking about UPI processing more than 6 billion transactions every month. So I think India's experience can therefore be extremely helpful to understand different forms of public intervention aiming at grabbing the benefits while at the same time minimizing risks associated to the operation of big tech players. That is why I think we are extremely fortunate to have with us a highly qualified speaker that could help us understand India's approach. So let me immediately welcome Dilip Asbe. He's a managing director and CEO of the National Payments Corporation of India, NPCI. Prior to this, he was the chief operating officer of the same company, and he has played an absolutely pivotal role in the design, the building, the operationalization, the management of large-scale innovative payment processing platforms in his country. He's a formidable leader to the core. He has been recently actually recognized with the Change Maker of the Year award for the revolutionary product UPI, which he spearheaded by one of the leading business dailies in India. So Dilip, thank you very, very much for participating in this event. In principle, this session is structured as a conversation. It will be more of sort of an interview. But let me start by asking you first to provide us with some brief introduction about UPI, what UPI is about, how it works. So Dilip, please, you have the floor now.
So thank you so much, Fernando, and thanks to BIS for giving me this opportunity to talk to all of you. And let me first talk about NPCI, Fernando. I don't know how many people would know NPCI. NPCI is an organization which was created and nurtured by RBI, which is Reserve Bank of India. I'll keep on referring it as RBI in my conversation. And it is created as a public good. It is what it means is it's a not-for-profit company. It can make the profit, but it has to redeploy the profits back into its operation. It doesn't give any shareholder any money back to the shareholder in that sense. The ownership is with the banks. Very recently, the ownership has been diversified to some non-banks as well, which are the regulated entities by the RBI. And it is actually set up as an extended arm of the RBI and the government to grow the digital payments and contribute back to the economy and scale the economy in that sense by increasing the speed of money, the digital payments, reduction of cash, and those kind of things. Being a not-for-profit, obviously it helps for support of non-monopolistic pricing. So it kind of guards the country on that. It does not depend on gyrations of the stock markets, protects the public good from the private interest, and the stakeholders of NPCI, which is including the public, government, RBI, the banks, and the ecosystem, are Very happy that NPCI is not for profit, and NPCI's intent is not profiteering or valuation. That kind of gives a lot of comfort back to the ecosystem. NPCI is very tightly regulated by the RBI, and for the right reasons. And the focus is, NPCI continues to remain very efficient and innovative. And we compete with Visa and MasterCard today in the country for the card payments, mobile payments, and our approach is always the localized innovation to compete with the giants like that. When we look at UPI and Aadhaar, which is the unique ID of India, and it's kind of these two public good infrastructures have actually fueled the whole growth of the fintech ecosystem, the digital payments, the digital KYC, all sorts of innovations back in the fintech community. And there is a BIS paper, and it says that if because of these two public infrastructures, India has achieved in 10 years what it could have taken a half a century to achieve. We have about 1,000 employees. We are a deep tech company. We build our own softwares. We own the IP and the softwares what we build, and we follow a very transparent approach back to the ecosystem in terms of whether it's a data decisions. While the regulators are very transparent worldwide, but the payment system operators are not. So precisely in consultation with RBI, we look at that. We are very transparent back to the ecosystem. So now, Fernando, let me go back to UPI and how it started and how it has contributed back to the ecosystem in last few years. When we look at 5 years back, India had about 50-60 million people who were working on active on digital payments, and the digital payments was only in the top cities in the country. And then the RBI started taking some steps, and let me list out those steps. RBI first started the payments bank as a category, given a license to few of the telcos. It's some of the small finance bank category started. Some of the microfinance institutions were given the licenses, and then the NPCI ecosystem was started, and some of the non-banks also allowed to participate in UPI, IMPS, those kind of things. And I think the intent was to fuel the whole. India is a vast country of 1.2 billion population, and it's a fairly diverse country, and we need a lot of capital, a lot of players to take the financial inclusion to the nook and corner of the country, and that was the whole intent, and that's what the UPI journey, start of the UPI journey. And while we started UPI, we had seen the example of what's going on in China, because obviously leader in mobile payments, and we had seen that China has the two large players, Alipay and WeChat, who are non-interoperable. The market was fairly fragmented, and basically, I think it's RBI's wisdom to create a fully interoperable system like UPI. The government also is very keen on digital payments, Fernando. So obviously, whatever growth you're seeing in India, the government also has to take a credit for that. And none other than Prime Minister Modi champions the digital payments agenda, including the creation of the JAM Trinity. We call it Jan Dhan, which is the account, Jan Dhan account, the mobile and the Aadhaar, which is all put together over 1 billion each. So that kind of, that's what is the starting point of UPI, and that's how it started, Fernando.
Okay, many thanks. And this looks like quite an exciting journey, the one you have gone through. Tell us, if you had to summarize actually the main social benefits actually that has been achieved since the creation of NPCI and UPI. I mean, what would you stress in relation to this? I mean, you are supposed to provide the public goods. So what type of public benefits you have brought to your country? And also, if I may, we will be also interested in knowing what have been the main challenges that you have found along the way.
So today, today the public benefit, if I just have to look at the current numbers, Fernando, it is, UPI in this current year, as per the current run rate which is going on, we believe that it will cross about $1 trillion in the current financial year. We have over 200 million users on UPI and about 50 million merchants. So I think this kind of creates a huge potential. We process about, we are going to reach very soon 4 billion transactions a month. financial transactions a month. We process equal number of non-financial transactions on UPI platform. Obviously, we don't speak about it, but it's a kind of it has become already a mega platform in that sense. And today from the current state, we believe that UPI still can grow 10x, right? Because we have another 500 million users to reach. We have another 50 million merchants to reach. So I think the whole collaboration, the whole investment will continue back into the payment ecosystem in the country, and we believe it's going to be another 10x growth possible. So you can imagine the kind of it helped India to deal with pandemic in a very efficient manner, because a lot of small merchants who could deal with the contactless payments in a big way during the pandemic. People could send the links to the customer, people could pay on the link. So fairly useful back for the India. The challenges, obviously, as you could expect, right? The challenges were taking the ecosystem together and in a big way, and a lot of hurdles in the last 5 years to take ecosystem together. India is a bank-led financial system, and when you look at the UPI takes the best of the both worlds, right? So what it does is it allow the money movement continues to remain with the bank, and the front end now, the consumer app actually can be provided by bank or a fintech. It has a choice. So banks today, if you look at the ecosystem, the banks also provide the apps, and non-banks or fintechs or startups or big techs, whatever you want to call, they also provide the app. The UPI architecture allows unbundling. So what happens is, the whole ecosystem becomes very diverse players with a different interest, right? And when we look at we use the steering committee as a predominant mechanism to drive the decision making and rule setting for UPI. And when we conduct the steering committee, a lot of different views comes, and what happens is, while the time passes, the challenger has become the incumbent, or the innovator becomes the incumbent, and he starts resisting the change. So various situations we'll have to deal with it while we want to launch the new features, the new things on UPI. But obviously, it's given in any country like India. We understand that there would be different approach, different point of views, and our approach is to try to take people as much together, Fernando. But I think taking the ecosystem together has been the biggest challenge for us, and keeping with such a diverse interest and the point of views.
Okay, thanks. Okay, I noticed that, of course, you have put much emphasis on contributions in the area of inclusion. So basically, to get more people making use actually of these payments facilities. And second, in terms of promoting as well innovation by the private sector, right? So probably interesting for the audience to know. I mean, how a public infrastructure like this one could provide benefits in those two specific domains, in terms of financial inclusion, in terms of promoting competition and innovation.
So the RBI provides the 3-year payment system vision every 3 years, and it has been doing last 12-13 years. And most of the NPCI platforms you would see are actually, adopted based on the vision document of RBI. And today, the UPI has been a catalyst to provide, as you rightly said, innovation and financial inclusion while keeping the diverse ecosystem together. I think because of 3 main, let me explain you the whole governance of how do we deal with the governance of UPI. And UPI actually operates on 3 layers. If you want to just look at, first layer is the trust of the banks with dealing with the money. Second, the first layer is also the front end, which is offered by the banks and non-banks together to offer UPI. The second layer is NPCI running the rules and regulations of the UPI ecosystem, and third is the oversight and approvals from the RBI to run the UPI ecosystem. Now, UPI, because of its it's the flexibility it offers in terms of, whether it's an asset-light merchant acceptance where, while we have 5 million POS machines, we could grow, the ecosystem could grow back to 50 million in last 4 years. Because of the asset-light POS infrastructure, the UPI ID, which is like an email ID, like a alias to send and receive the money, it kind of gives a various simplified ways to send and receive money. We have recently launched AutoPay, which is the recurring transaction solution back for the ecosystem, which once the customer sets up the mandate on the phone, you can actually virtually create the very starting point of, you can say, that programmable money on UPI. And very recently also we have launched something called as eRupee, which is the prepaid vouchers on the UPI platform, and which government can use it in a big way to drive the social benefits, the gift cards, and those kind of use cases. So what I'm trying to explain is, the UPI is fairly context-free, Fernando. So the ecosystem can layer the solutions on top of UPI, which kind of helps to grow the innovation in the ecosystem. And with so much of payment data, what has been created now, where we didn't have any data for the Indians 5 years back, now the 3 streams, the credit, insurance, and investments, we believe that now they can grow because that needs a data, that needs understanding of the customer, and the payment data gives that understanding of the customer. And I believe these 3 fundamental streams can grow about 100x. The leveraging the payment infrastructure what we have built.
Okay, many thanks. Okay, let's now move to probably the core part of this conversation, which is obviously something which is in line with the type of issues that we have been discussing in this conference today, and we'll continue discussing tomorrow, which is this interaction between UPI and big techs. So I introduced this session by saying, referring to what has been discussed actually in previous session, that maybe India can provide an example of how the provision of a public good, a public infrastructure, may actually reduce the need to very, very sort of intensive intervention by specific regulation on the activities performed by specific players like big tech. So how do you see actually this? What could be the role of the provision of a public infrastructure? Is it true that by putting in place a public infrastructure, you don't have to be that intrusive in terms of regulating the activities of some relevant players in the different market segments?
No, it's a great question, Fernando. I think when I look at UPI as a public infrastructure delivering the public good, which is much more than big tech issue which you are raising, because when we look at from NPCI standpoint, and when we had decided that we will permit the non-banks to perform some specific role in UPI, we had to treat everybody equally, whether it's a fintech, whether it's a big tech, whether it's a startup. We can't actually differentiate between any of the players which are participating in the UPI system from a non-bank standpoint. Right, but when I look back, I think it has created a win-win for a country, because for a large country like us, we need many players proliferating the payment system like UPI to such a vast country. And let me explain, but how the architecture of UPI kind of helps us to limit the risk which are created in the system. And let me take a point that whether the non-banks are creating a risk back on the payment system, and let me try to articulate how UPI architecture and the design supports that. The first point is the money remains back with the banking system, right? So money doesn't go out of the banking system. So while the customer is using a fintech app, the money remains back with the banking system, which is fully regulated by the Reserve Bank of India. The second is the access to UPI is only provided through the banks, right? So there is a category called payment system provider, PSP banks, and all the big techs actually comes, big techs or a fintech or anybody comes through the PSP bank to the UPI system. the authorization and authentication are two critical activities in the payment transaction. Both the activities are actually performed by the PSP banks, right? So we have kept the control activities mainly with the banks. And when you look at in a way, what the UPI architecture forces the very tight collaboration between the banks and non-banks, right, to play this role. And earlier we used to get the complaints that the bank, NPCI is not treating the banks and non-banks at par, and the non-banks guys were complaining initially, but obviously when they saw that the takeoff of the payment system by the non-banks on apps, obviously this complaint died down on its own. And also, the other thing, very important thing, Fernando, I would like to explain is the customer trust. The way we have tried to protect. I'm saying customer trust or customer protection. What we have adopted. So RBI has announced that online dispute resolution has to be implemented. What it means is the customer can raise the dispute from his app, UPI app, and that dispute has to resolve real time. And it's very important. I don't think anywhere else in the world this has happened, but we have started implementing this with UPI. Few banks are live, but we believe that in 30 seconds, any grievance on UPI which is a technical in nature, will get resolved in 30 seconds, right? And that's a big step towards the customer trust on UPI as an ecosystem. We have put up a lot of penalties on delays in credit and those kind of operational inefficiencies on the ecosystem. We also kind of display on NPCI website very transparently the NPCI, the ecosystem, including the NPCI performance. So that kind of helps to build, kind of a complete transparency and the trust of the customers on the way UPI is being governed and managed in the ecosystem. So that's the way we look at it, Fernando. So obviously nobody can say that risks do not exist, but obviously it's a long-term journey, and I think our job is to ensure that how do we limit the risk.
Okay, I understand that it's not only about actually providing a public good, a public service. It's, well, you put in place this public infrastructure, but of course you establish some clear rules that will obviously help address as well actually the risk we are interested in controlling, right? So, for instance, what you said, right, is account services are just provided by banks, if I'm not mistaken. So that means, of course, that all payments are actually settled in commercial bank money. That's important, right? And second, there is this data sharing obligations, right? So that, in principle, upon consent by the customers, of course, that data could actually be shared, would have to be shared actually with all participants in the platform. So you provide the public service, the public infrastructure, and you establish very clear rules of the game. So how do you strike the balance between sort of regulating while at the same time, in order to address risk, and while at the same time, of course, promote innovation, which is part of your objectives here?
Again, a very good question. And let me just, touch back your last point, very important point. I'll come back to this answer. The data privacy law is already around the corner, right? And we believe that already the market has started. The draft code is already in front of has been released back to the country, and we believe that any moment it will get approved by the parliament. And it's very important, right? Because that data sharing is another risk back to the ecosystem, because any ecosystem which is generating a lot of data, the data sharing risks are paramount. And we believe that, because the draft code is already there, the ecosystem is already adopted to the draft code. So that kind of mitigates the risk of, having the data sharing, the data selling, or illegal use of data without the customer consent, the consent architecture. All these things are already started getting adopted by the ecosystem, and we believe that the privacy law would be in place. Now, coming back to your question, see, I think India experience demonstrates that it's never a regulation versus innovation. That's our experience says that, because when there is a responsible innovation in a regulated space, right, with the backing of the regulator and the government, it provides the population a great value from any public good infrastructure like UPI or Aadhaar, which I spoke about. So, let me give you some principles, and we obviously got to some issues, and today what we have done is, we have adopted the principle of direct and indirect regulation while participation in India, UPI. And when you look at the direct regulation, obviously the banks which are directly regulated, which are direct participants on UPI, the indirect regulation is worldwide adopted back for the merchant corporates who access the clearinghouse using their sponsor bank. So similar regulation which was done, which I explained just some time back about the PSPs, which is the Payment System Provider Bank, and the TPAP, which is the third-party app provider, which kind of participates with the UPI with the indirect regulation. And technically, when you use the big tech, I would like to highlight that some of the big techs were already present in India or worldwide in the payment system before they started in UPI. So, for example, Google or Android Pay was already providing the card-based services. Amazon, because of their e-commerce businesses, already they were tightly linked back to the payment system. And I think the only exception I could say that the WhatsApp started the payment system entry with the UPI in that sense. And when actually, let me narrate you one experience, and what we tried to formulate the policy, which we're trying to help the innovation and regulation as well. Because while you look at the Google Pay, PhonePe, or any other leading third-party app provider floated their own app, WhatsApp already had, when they were starting UPI, they already had about 400 million active daily users. So we obviously were worried that, the WhatsApp could have the undue advantage of their already large daily active users. And there we thought that, we need some regulation in terms of concentration risk, and we came up with a market share cap on the UPI ecosystem. And we put up a 30% as an overall cap, and we have given the 2 years time to the existing players. 2 players are above 30% right now. While the cap worked very well for the new players, obviously the existing players continues, PhonePe and Google Pay are above 30%. And we kind of now have to ensure, we believe that the market should balance itself out. But if it doesn't, then obviously NPCI will have to take action. And we are kind of have to see that, while taking action, we don't hinder any growth of UPI. So that's a challenge. But we believe that with WhatsApp coming in, with the other leading apps in India, Amazon Pay, Paytm, the market should balance itself out. We are also working with the bank because the banks didn't convert the mobile banking app to UPI in the beginning. I'm saying now we see that a lot of banks have now put in the effort to convert their mobile banking app, which are very strong apps, to be honest, and very trustworthy apps between the very popular apps in the customers. So, iMobile, which is the ICICI Bank app, YONO, which is the SBI app, are in the process of getting converted, right? So I think just to sum up, I think in India, if we work in the regulated space, because the government and the RBI both have an innovation-led approach, technically it never becomes so much of balance issue, right? And obviously there are some cases where the balance issue comes in. Obviously the regulator steps in to deal with the situation in that sense.
Okay, many thanks. So the situation now, again, on this interaction between big techs and UPI, right? Big techs are there, incredibly active. Basically they are in the middle of large majority of transactions will take place there. But they are specialized in specific type of payment services, right? So what in Europe will be called like payment initiation or something of that sort, right? So they don't provide actually account payment services, right? So this is what they are doing. Apparently they find it profitable, although they cannot leverage on data superiority as they normally do in other parts of the world. So my question is, how comes that first the big techs find it profitable, this sort of very narrow type of business model, and second, whether eventually could we consider actually to allow them to offer other types of services in the payment chain? How is your current take in relation to this?
See, today, to be honest, I don't know what role they would like to play. I think they should know this better. And I think RBI has a fairly diverse amount of licenses which are given to the non-banks. Whether it's a prepaid payment issuer license for the wallet, that's a regulated category. Today many of the big techs like Amazon already has a license. PhonePe has a license on wallet. They're already regulated entity by RBI. The RBI also has come up with a policy or a license on the payment aggregator, payment gateways. So many of them would also apply those because they do this aggregation business in that sense in the country. So I believe that the game will keep evolving, Fernando. I don't know, to be honest, what is that their next steps would be. But there is some players amongst the big tech already are getting applied and playing some different roles. When there is a Bharat bill payment system which is operated by NPCI, so there is a biller on BO operating unit license which is taken by PhonePe and the others. So already there are mix and match scenario, if I may say so. But obviously, I strongly believe, looking at the huge under-penetration of credit, investments and insurance in India, I'm very sure that most of the non-banks in India, which is all big techs, fintechs and startups, would want to play a role in credit, investments and insurance. I think it's going to be very lucrative. I spoke about 100x growth possible in those areas. So I believe they will use payments as a stepping stone to leverage those areas.
And there will be, in principle, the policy approach by the Indian authorities will be actually sort of open to consider that possibility. If not, there will be a sort of regulatory constraint for particularly big tech to expand to match their business model and to get into different business lines.
So, I don't know, to be honest. Today, if they want to do credit, they can partner with a bank. They can partner with a NBFC, right? Non-banking finance corporation. If they want to do insurance or they want to be a mutual fund distributor, they can go to SEBI and take the license on mutual fund distribution, or they can partner with the existing license provider. So I don't know what model it will pan out and what will be their choices, but many of the fintechs are already started exploring these areas because India is flooded with the liquidity on investments on fintechs, and many of the investments are coming into these three areas, Fernando. So I strongly believe most of the startups and fintechs, including the big techs, would approach regular. Either they will do it indirectly, aligning with the existing partner, or they'll apply for the license on all the three areas directly.
What about? Okay, I think it's a very clear answer. So there could be a business case actually for them to get into different lines. In principle, the regulatory approach will not necessarily provide obstacles for that. But what about commercial banks? I mean, you have this infrastructure, there is much data going on there. In principle, they could have access actually to that data upon customers' consent. I mean, do you think that banks are actually making use of that data, for instance, for the credit underwriting activities and other activities that banks would actually perform?
So the draft privacy code, which has been put up on a public domain, clearly articulates that the data is the customer's data, right? So anybody intends to use that data, whether it's a bank, non-bank, or anybody in the supply chain, has to obtain the customer's consent, Fernando. So I think the rule will apply to everybody in that sense, whether it's a customer's bank or customer's other bank or to the non-bank. Anybody in the supply chain wants to use any data, they will have to go back to the customer and ask for a specific consent in that sense.
Okay, very good. Thank you very much. That's been an interesting experiment. Anyway, of course, looking at UPI, all this information you have conveyed to us, incredibly successful initiative in many respects. So the natural question here is about exportability. So how would you see actually the UPI model being introduced in other jurisdictions, both in emerging market economies as well as in advanced economies? What will be the conditions actually that a jurisdiction will have to meet in order to have the possibility of putting in place platforms such as UPI? I mean, have you thought about that? I'm sure you have. I mean, what type of hints you could actually provide us with in relation to this?
So we, Fernando, again, very good point, and I would have spoken about this in the presentation. And so we have formed an NPCI International to look at the internationalization of NPCI's all platform, including UPI. And it's a separate subsidiary, and it has its own focused approach to deal with the world market. And somewhere we believe that the low-cost real-time payment system with a vibrant fintech ecosystem, it really adds to the country's economy in a big way, in all sense. So we believe that any country adopting a UPI-like system obviously will have to have the government and the regulator backing, Fernando. Otherwise, I don't think it's possible for any country to build a diverse payment system or a latest payment system like UPI, which has diverse players from all section. It is impossible to do that. But if, for example, we at NPCI International, I think working with some of the global regulators to see whether they need UPI, and it's already proven the scale and the operational capability and the latest features what any country would aspire to have for. And NPCI is ready to kind of open source UPI to these countries under the government to government or a central bank to central bank arrangements. So we are very open because we believe that we have created a public good for India, and I don't think NPCI standpoint we would like to see it becomes a public good of the world in that sense. But obviously under the regulator to regulator or the government to government arrangements, and I think we can save a lot of efforts by the country to reinvent the wheel entirely, which we have struggled last 6 years to get to build a world-class platform like UPI. But obviously it's their choice. But we are approachable, Fernando. So any country is looking at UPI can approach us directly through their government, to regulate their regulator to us, to our government or our regulator. And we'll be very keen to engage into dialogue and open source UPI so that they don't depend on India, they don't depend on NPCI to continue their domestic journey in that sense.
Okay, many thanks. I think it's a very good offer, frankly. That may be interesting for some people actually listening to this conference, certainly because of what you provide, a very interesting example that could actually be exported to other jurisdictions, at least in other jurisdictions meeting the conditions you basically explained, particularly with respect to government buy-in and all this. Right, I think it's very, very helpful. What about cross-border payments, cross-border transactions? Do you feel that this type of framework could be scalable, can actually be used in a cross-border context? Do you have any, maybe already some practical experience on cross-border transactions being performed with UPI participation?
We worked with BIS to write the BIS and the Monetary Authority of Singapore to create the paper on the real-time, cost-efficient cross-border transaction. Obviously, we have not implemented that with any country, but obviously the discussion is going on as of now. If you if you look at currently the challenges in the cross-border is the sender do not have the details of the beneficiary. The sender do not understand, sender or receiver both do not understand what are the FX conversion and the charges. The settlement to corresponding banking arrangement is fairly inefficient in that send, and the both side has the complex regulation and compliance requirements, which kind of makes it really very difficult to make this very efficient from that perspective. And recently the Indian regulator and the Monetary Authority of Singapore, Singapore's regulator, have come together to announce a real-time platform linkage between India and Singapore, which is India's UPI and PayNow from Singapore. And it is slated to go live by July 2022, which is next year. And what are we trying to solve there is, can we get the transaction done in 30 seconds, right? Max 60 seconds. Can we ensure the transparency of the charges to the sender, FX or any other charges? And can we ensure a very efficient settlement mechanism? I think these are the three problems we are trying to solve along with the Singapore system. And when we actually deep dive into this whole discussion, right? Many of the problems on the domestic payment system we try to solve, right, and which has been already solved. To just give you an example that getting the beneficiary details before we initiate the transaction in any real-time payment system is already in place, right? Already in place. When you look at the validations transaction, already in place in that sense. When you look at the availability of the smart UI, UX to the customer, already in place, where you can show the charges, the FX conversion, all these things. Near real-time settlements 24/7 already in place. Effective settlement guarantee mechanism already in place. So I think the real-time payment systems are really in a position to all the three problems which I spoke about to solve. Obviously, it solves all the ticks on the box, but what needs to happen is two regulators have to come together to make this happen, because there are going to be challenges to solve this, and I think the regulators' role would be very crucial. Today, the settlement efficiency also can be brought in by the regulator, because today most of the domestic payment systems settle in the regulator's account, bank's account in the regulator's books. So if the international settlement also happens regulator to regulator, it kind of adds up, gives that guarantee in that sense, and also adds up that efficiency leg what is required. Otherwise, that pre-funding arrangement, bilateral pre-funding arrangement, all those things may not work out, Fernando. But I think it's a very possible scenario, and we have decided to go live in July 2022. So I hope next year, when we speak similar time, I will give you the good news that we have gone live, and now this real-time payment system cross-border is replicable across the world.
That would be great. Huh? Sounds like a dream. Very good. I'm conscious of time. We're supposed to finish in 1 minute, but being in the BIS, you will expect I should ask you something about CBDCs. So just your views about what is the scope to introduce a CBDC in your country, in India, whether the existence of efficient, fast and cheap payment systems somehow reduce the need of CBDCs, reduce the business case, or weakens the business case for our CBDCs or not. What is your view about that? I mean, what would be your expectation in terms of prospects for the introduction of the central bank digital currency in India?
So, obviously, I also got to know that the RBI is planning to launch the CBDC, and every country has a very different objective to launch CBDC. And and as you rightly said, if the country already has a very efficient domestic payment system, it kind of narrows down the need of CBDC in that particular country. But let me tell you about India. India has about all of us know 1.2 billion population. Still, cash is fairly high in India. So I think if the CBDC can replace the cash, and that can actually really add value. And let me tell you two properties or kind of value add for the cash. Why consumer prefers the cash for various different reasons, but I think the two reasons is the instant settlement, and second is the anonymity, what it offers back to the customer to while doing the transaction. So I think if CBDC in India is able to address these two aspects, I think there is a huge space in that sense for the CBDC to play a role in India. Obviously, the RBI will decide at the appropriate time, because various countries are in different times and different places of trials, whether it's a retail or wholesale, whether it's a token-based, account-based. So obviously, RBI will disclose its plans at the right time. But we believe that if CBDC attacks the cash, right, because nobody would want to create the duplication in the country. So I think if it attacks the cash, it can add huge value. And in that sense, RBI's policy has been that the multiple payment system, the choice to the customer is paramount in India. However, I don't know. I keep hearing about the cross-border transactions using CBDC. It's a very complex topic, Fernando, to discuss in a few seconds, because every country will use a different token structure, the different smart contracts. So it's going to be very complex to connect the one CBDC to the other CBDC. While obviously it has the advantage that if you if you design the CBDC is starting on a clean slate. So you can keep those design parameters in mind, but obviously the token exchange, the token standards, the smart contracts, functionality to match it between both the countries is going to be very complex and very very difficult process, but it's possible. Obviously, it's possible.
That's great. Many thanks. Incredibly insightful remarks. I think you have added a very important new angle to our policy analytical discussion in this conference. So I appreciate very much your contribution. Thanks a lot. So let me adjourn now this first day of the conference by reminding you that tomorrow we will have the second day of the conference. We will start again at 1 p.m. Central European Time with an incredibly promising keynote speech by the governor of the People's Bank of China. I'm sure that that speech will also be highly illuminating. With that, all the best. Enjoy your rest during the rest of the day, and I hope to see you all again tomorrow. Okay, bye.
Thank you.